validation, now I validate myself. Building inner strength, putting doubt up on the shelf. No more unnecessary drama, no more wasted time. Climbing higher constantly, making my own climb. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. Whoa, I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield. Standing on higher ground, where excellence is found. My potential knows no bounds. Raising the bar, breaking ground. I'm not just living, I'm manifesting my vision. Cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield. To mediocrity and chaos, I will never yield.
Come on, y'all, try me with this mic thing. How you doing, ladies and gentlemen? It is hot as ball. Jesus. Whew. It is hot. All right, y'all. We gonna get through this today. Um, thank you for coming to this and that. I'm your host, Xander, where we talk about this, that, and everything in between. And I gotta tell y'all every day, while we do not let the sun rise without going live, we don't always start on time, and that's why we ask you guys to like and subscribe, mash those reaction buttons while you're here, and then hit those notification buttons so that you know that we've gone live. Also, we've been doing a good job with having a lot of releases coming out, so make sure that you guys double check the membership because there's a lot of stuff going on in the membership. I'm making it a point to have stuff like 2, 3, 4 weeks in advance ready for y'all to get it. So even if I'm too busy to let it go, y'all got something going on for y'all. Steven, I did do that background information on yesterday's question that you asked me about. I'm going to piece it together because it's a part of the topic is like an anger management thing, but I have to try to tune it for situational bullshit because that's what you were asking me about was like how do you maintain anger in like unexpected circumstances where people are just uncooperative. So I'm still working on it, but I did dig up all of the information related to it. So give me another day or two, and I should have it in the membership for you, and then we'll try to put it up on one of the upcoming shows before I start doing more scripts for some of the upcoming shows. So I'll be moving some shows around to make sure that that show is up there, but not any of the shows in the next like 5 days. So maybe next week, Thursday or something like that, something that I haven't done a script for, or probably one of the first uh, Friday or Saturdays in August, something like that. I think that's the same thing because we're in the last week of July. Either way, it's going to be coming up soon. So just giving you a heads up on that. Now we have different topics every night of the week. Sunday is questions and comments from the fans. Monday we talk about how business and politics it just doesn't work well with you because specifically on Monday is how politics negatively impacts your ability to make, save, and invest money. Right. Then we have on Tuesdays, we talk to you guys about how to make, save, and invest money. Then on Wednesdays, we give you guys information on how to go to different countries around the world to potentially live as well as invest for international investing. And then Thursday, Friday, and Saturday, which is why Steven's topic of choice would be fantastic for one of those weekend shows, is personal development, self improvement, so relationship topics, socialization, negotiations, building your brand, and then your promotions, raises, um, retirement, forced retirement, termination, and then giving you all the information that you need and all of the reasons why that it's important for you to build your 20 and 30-year plan. Um, we've got a lot more stuff coming up. It's an exhausting week, I gotta tell you. This is this is the summer heat that we should have experienced like 30 days ago, and it is by far getting even hotter. So I don't know. Maybe I'm gonna have to start putting some ice buckets all over the place to kind of cool things off. Good idea. Put some ice buckets in front of the fans. Be working that machine in overtime, trying to keep it cool in here till we can get the AC units back up and running. But for almost $300 a month for just the air conditioner for 2.5 weeks out of the month, I'm like, man, that's all right. Um, if we can survive until September. I don't know how to survive until then. We're gonna figure it out though. But today, since we're today being Tuesday, we're supposed to be talking about different ways to invest. So today we're supposed to be talking about bridge loans with bad credit. Because a lot of people who talk to you guys about um, real estate investments tell you, oh yeah, you can do all kinds of shit even with bad credit. We're gonna see. Um, because take for example, you just found a perfect opportunity to distress property, and a distressed property is one that needs a little bit of fixing up. It's not a ready to move in property. You think about like a business expansion or something like that. It's a deal that you can't miss out on. But you're gonna need to close the deal in 10 days. That's a problem. Another problem is your credit is taking a hit, a huge hit, and the banks won't even talk to you. You're about to watch that golden opportunity slip away. But what if there was a way to get the funding in days, not months, using the asset itself as collateral, the property that you're trying to get? And there is a way, and it is called a bridge loan. But this lifeline comes with a dangerous trade off that could cost you everything if you're not careful about it. So, in tonight's show, we're going to expose the speed versus cost traps of bad credit bridge loans. So, let's be real. The traditional finance system isn't built for speed, and it's definitely not built for second chances. You walk into a bank with a FICO score that's been beaten up, maybe from past business failures, a divorce, or even medical bills, and the conversation is over before it even starts. The loan officer sees a few late payments or a past bankruptcy within the last 5 years, and the answer is a polite but firm no. Doesn't matter if you found the deal of a lifetime. Doesn't matter if the asset that you want to buy is a guaranteed home run. The computer says no, the agent says no, and the clock is still ticking. The seller of the undervalued property needs to close by next Friday. The auction for that piece of equipment is tomorrow. Every day that goes by, you can feel the opportunity dissolving around you. It is an immense quantity of stress. It's a uniquely frustrating and frankly infuriating position to be in. You have the vision, you have the hustle mentality. And because of a number on a credit report, a number that reflects your past, not your future, not even your present, you find yourself stuck on the sidelines watching someone else win that exact same deal. This is the exact moment of desperation where the world of alternative financing opens up. And right at the front of the line is the bridge loan, promising to do what the banks can't, which is get you the money and get it to you now. So, what is this financial tool that seems to play by a different set of rules? A bridge loan is sometimes called a swing loan or gap finance, if you guys have heard of it in that term. It's exactly what it sounds like. It's a short term loan designed to bridge a financial gap. That gap is usually between an immediate need for cash and a future larger financial event. For a homeowner, it's buying a new house before selling their old one. For an investor, it's grabbing a distressed property at a discount before long term financing is in place. But here's the most critical thing to understand, the secret that makes this possible for someone with bad credit. Bad credit bridge loans, especially from what are called hard money lenders, operate on a different philosophy than a bank. While a bank is obsessed with you, your credit score, your income, your payment history, hard money lenders, their attention is focused primarily on one thing, the asset itself, the property, the collateral. This is a fundamental shift in thinking. Your troubled credit history, while not completely ignored, becomes a secondary concern. These lenders aren't just lending to you, they are lending against the value of the property that you're trying to acquire. They look at a deal and they're going to ask, if the borrower defaults and we have to take it this property, can we sell it quickly and get our money back plus a profit? If the answer is yes, then your past financial struggles are an obstacle that can often be overcome. Bankruptcies, foreclosures, collections, they don't have to be a deal breaker. This is the secret door that opens when all the bank doors have slammed shut. It's access to capital based on the strength of your deal, not the perfection of your history. So, how does this work in the real world? How can a lender look past a bad credit score? Because there's risk, and the risk is calculated in a completely different way. So, let's call it the asset first model. The foundation of this world is a term that you have known if you've been paying attention to the show, which is a loan to value or LTV. Loan to value is a simple percentage that represents the loan amount compared to the value of the asset. So if a property is worth $500,000, you get a loan to value for $350,000. Your LTV is 70%. For a traditional bank, they might go up to 80% or 90% or even 95% loan to value on a mortgage. But that high leverage is usually available only to borrowers with stellar credit and often requires government backing or private mortgage insurance. A hard money bridge lender takes the opposite approach. Now, they will typically only lend up to a more conservative loan to value, usually capping at about 65 to 75% of the value of the house, meaning how much can it be sold for, either now or after you finish sinking all of the money that you're getting for it. And that's going to be two different values. Because if I buy the property now and do absolutely nothing with it, the value of the property is going to be different than if I'm borrowing money from this hard money lender or bridge loan to renovate the property and then try to sell it, where I would put repair into it. And the after repair value, ARV, might be a little bit higher than the uh, loan to value, right? So you might have a higher value after repair value. So typically they want to go on the lower end of the two and try to do about 70, 75% of the loan to value of buying it right now, or maybe 65% of the after repair value if you're actually borrowing money to do renovations on the property, right? For experienced borrowers or for the right deal, some lenders might even stretch it to 80%. Why do you think they use the lower LTVs? Well, because that difference, that 25 or 35% gap, is their safety net. It's called the equity cushion. And this was the same safety net that I mentioned to you guys when I told you guys about leveraging your portfolio, where if you have a portfolio that is valued at over $100,000 and you borrowed half or less than half of the portfolio, even under the current economic pressure where values have dropped by 20% or 25%, if your portfolio would have gone down from 100% of what it was when you borrowed the money, if it would have gone down 40%, it would still be 10% higher than what you borrowed, which prevents them from triggering an action or reaction to the market. All right. That's not something that a lot of people know about. They think, well, if I've got 100 grand and I can borrow up to 75 grand, I'll borrow the 75 and then I'll make it do what it do. But under the current circumstances, if you would have had over 100 grand and you would have borrowed 50 and your value of your shares would have dropped down to $70,000, you still would be able to maintain the 50 grand that you had. You still have the ability to pay down the 50 grand, but it doesn't trigger an event because whether or not the market goes up or not doesn't change anything until it goes down another 10 or $1,000, right? That cushion between borrowing all of the value out or leaving some value there to fluctuate with the market is the equity cushion. And this cushion is the lender's ultimate protection. They know that if you fail to pay, that they can foreclose. They can sell the property at a discount for a quick sale. They can pay off all the fees and the costs and still walk away with their original investment completely back in their hands and then some. Your significant down payment or the equity that you already have in the property is what gives them the confidence to lend. And a lot of times, what they'll do, if you're coming to the table with very little cash up front, they may talk to you about things like leveraging other assets. If you have other properties, preferably estate properties that have monetary value, they typically give you up to 50% of the value of those properties. So if you have two or three or four houses under your belt, and each one of them has no mortgage against them, you utilize each one of them at 50% of the value of that house to go and leverage towards a deal. If you're, let's say you're trying to buy a $500,000 house, let's say you have four houses that each of them cost $250,000. That means you've got $1 million worth of assets, right? Already. Let's say that you're a mid-grade real estate guy. Now, you could turn around and say, well, let me leverage all four of my houses for this hard money loan situation, right? This, bridge loan situation, right? Because they're going to give you 50% of the value of each one of those properties, they're likely going to give you at least $100,000 or $125,000 for each one of those houses. With four houses, you're looking at almost $500,000, which is the whole loan that you are asking for. So in this dynamic, not only would they potentially cover the loan because 100% of the loan is back, they may even give you some on top of that to repair the property, $50,000, $75,000 more to repair the property, which has you walking into the deal with no cash in hand, leveraging assets that you already have, and then getting money back to rehab the property that you're buying, and then use the property that you're buying as an asset to pay these people back. Whether and there's two ways to do it, and I don't know if I put it into the script today, but there's two ways that you can do this. Because if you were a fix and flipper, this will be one of those things where you leverage what you have, pick up a property, uh, sell it, and then pay the people back. But you can talk them into, if you're doing buy and hold rental properties, percentage of the rent off of the property as collateral, where you can say, well, I've got like four rental properties. I'm trying to pick up a fifth, and then I'll pay you a percentage to pick up the fifth. They'll take that deal if there's enough money involved with the five total rental properties that you have. And you'll be in a situation where you can lock it in and not have to do with the banks what you would have to do with the hard money guy. Stephen says, this is the common knowledge that is uncommon that you refer to right here. This is the exact stuff that I be throwing into the membership. I'll be talking to y'all about. This is the stuff that nobody really talks about. Um, the truth of the matter is there's so many opportunities out there. Not all of them do you qualify for, but there's so many opportunities out there. And if you weren't looking, you would have never known. So for an individual like you, Stephen, um, you're coming out of college, you're going to be backed by a bunch of student loans. You might want to try to buy yourself a property. You don't necessarily have the right credit score to get yourself in the door. Depending on the lender, depending on the lender, you might be able to talk them into helping you pick up a rental property that you can utilize, a duplex or a fourplex, a town home, right? Where you stay on one side and rent out the other side, and they'll help you get right on in there as long as you're putting down enough capital towards it. Some students do go to college and use the student loans and buy themselves a house cash up front so that they have the house, so that they have the secured house, and the only thing that they're swimming with is the debt from the student loans. That is one way to operate. That's a getting security out of college, is to go to college, borrow a bunch of money from college, buy your house out cash up front, buy your car out cash up front, so that you own the two things, the two largest assets that you really need credit for. Everything else could go to hell, because you use, honest to God, you don't know this, but when you go to trade in your cell phone to get an upgrade, they do a credit check so that they can finance the phone for you. They don't tell you that though, but they pull your credit to see what your credit score looks like. And if your credit score is low, they'll tell you that you don't have that much available capital to finance a phone. But if your credit is good, then they'll tell you that you got enough money to finance a brand new iPhone 17 or iPhone 25 or whatever. And then all you got to do is just put down the basic $600, and then they'll just prorate the rest of it. Right. Also, your credit score is your insurance. So if your credit score sucks, your insurance is higher. Even though you pay your insurance all the time, if your credit score sucks, your insurance is higher. You'll see another turn of events. Um, so if your credit score is and what's a good credit score, really? Most people say like 640, 650. That's probably a good number to sit at. That's bad credit, but it's kind of good. It's kind of fair, right? It's not fantastic credit. You've fucked up in your past, but you kind of got yourself stable right now. It's the kind of credit score that might get you a Capital One credit card, but it's not the kind of credit score to get you an American Express credit card. It's the kind of a credit score that might get you a decent down payment on a brand new car, but it's not the kind of credit score that'll get you a no money down kind of car with 0% interest for the first 24 months kind of credit score, right? And if you've got like a 640 or a 650 or 675 and you just can't find a way to get it over the top, you're in that situation where if you were to walk into a bank is going to either ask you for a shit ton of money or they're going to tell you no. If you've got a shit ton of money to go towards it, then they'll tell you yes. But if you don't have a shit ton of money to go towards it, they're going to tell you no, right? And that's one of the wildest parts. You know, I've been thinking, I've been thinking, I wonder if we can take a 640 credit score and go and grab a $5,000 cash loan for 24 months just to see. He says, iPhone sucks. I'm on my way now. What did he said? A 13. I would never finance a phone. Before this, I used to go to Walmart and always buy the cheapest smartphones on Straight Talk. Bro, hey, I'm with you. I'm with you. Now, I started buying phones brand new, cash up front in college, back when they were $700 a phone. Now they're $1,500 a phone. So now I don't buy the phones cash up front. But the problem that I have these days, because like right now, I got a 2023, I got a brand new 2023 when the 2023 came out in September 2023. But they set it up where they only prorate it if you trade in the old phone or if under some circumstance you're activating a new line. I've got a really snazzy plan where I'm getting like half of my lines for free. I'm not going to fuck that up by adding an extra line to it. So that means in order for me to do a true to life upgrade, my 2023 must be outdated, which is probably going to be 2028. Then I have no choice but to upgrade because the phone is no longer valuable to the network. In that scenario, they'll do an upgrade process, take my old phone, put the value of that phone towards some of the taxes on a new phone. I'm still going to give them 600 bucks, but then they're going to charge me the difference on my rate plan where I'm actually only paying like $400 for a brand new 2028 phone. Uh, that's the only reason why I do it that way nowadays because it makes sense if I'm keeping my phone in good condition and the I don't really store much information on my cell phone and everything can transfer over from one device to the next. So when I'm doing an upgrade, I'm only doing an upgrade when I have no other choice. If but back when I was in college, I would just get an upgrade every year because I didn't know any better. And Obama was paying for everything with all the extra student loan money that was being passed around. But these days, it's like no, I could save money because I'm ultimately renting the phone otherwise, right? I could just save money and just, trade it in when it is absolutely necessary. So the day I get the report that my 23 is no longer backed by updates, that's when I'm going to go to the phone company, say, hey, I want to upgrade this phone to the newest model. And the reason why I'm doing the newest model is because it usually takes 5 years for the model to be outdated. So if I'm going to put $400 down on the phone once every 5 years, that's less than $100 a year for the phone. And I'm using it every day, all day. So it kind of pays for itself. But it is still a financial liability because the phone doesn't turn a profit. I can use the phone in my profit making, but the phone doesn't necessarily turn a profit. Right. So it is still a liability. But yeah, iPhone does suck in my observation. It is not nearly as effective as a Samsung. Um, but iPhone is buying hardware from Samsung. So the difference between iPhone and Samsung is the software. And I don't personally like the user friendly platform of iPhone because it's not customizable. You can't add anything different to the more so than Android because if they have iPhone, all iPhones operate the exact same way. And that means that if one phone goes down, everybody who has that same phone has the same experience. I got like three Androids right next to me right now, and they're none of them are the same. None of them are the same. I got an A34, I've got an S23, I've got a Go 5G. They're all Androids, but they're not even the same company. So one of those phones, one out of three of them might get got, but the other two, not so much, right? And when I'm trying to avoid hacking, I would buy a MacBook Pro because not too many people have that. Everybody's got Windows, but not everybody's got a MacBook Pro because they're too fucking expensive. I would get a MacBook Pro computer, or I would get an Android cell phone because those are the least used devices, which hackers are going to avoid because they want to do the most devastation in the shortest period of time with the least amount of effort. So yeah, I provide you guys common knowledge that don't nobody really pay attention to, and this is crazy. So pay attention. This is going to be why your bad credit becomes a secondary data point. A foreclosure from 5 years ago or bankruptcy from 5 years ago doesn't change the current appraised value of the collateral of the property that you're using. A low FICO score, where part of that low FICO score is going to be a large quantity of student loan debt, but it's weighed heavily in certain situations and not weighed heavily in other situations. But you will have a larger quantity of revolving capital where you have like credit cards if you got a lot of credit cards coming in, or if you have a lot of short-term loans that negatively impacts your credit score because when you do those buy now pay laters, those are short-term loans, and those decrease the average um lifespan of your overall credit report. So say you've got like I've got student loans from back in 2009. That's a long credit history. The average though is going to be the longest line of credit plus the shortest line of credit divided by the number of lines of credit. So if you have a bunch of 6 month uh, uh, on again, off again credit lines versus a lengthy scenario, your average starts becoming 1 to 2 years or less. That average is a problem. That smaller average is a problem, right? You need to have installment plans that are significantly larger. You need to have revolving credit that is significantly more beneficial to you, where you have 10, 15-year accounts, right? That's stuff that people don't consider or reconsider when they're looking at their FICO score. So you can end up with a low FICO score just because you financed your Jordans, you financed the WWE title, you financed your PlayStation, you financed GTA 6 online, you financed a new laptop, you financed some new clothes for your girlfriend, you financed some Christmas gifts for your kids, you financed something for Mother's Day, and you're paying $50 a month on each one of these things, and you paid everything on time, you didn't miss a payment, you paid everything off, but your credit score went down. Reasons: one, because each one of these were short-term installment loans, and two, the loan is over, it's paid off. It was paid off inside of 6 months, right? So a low FICO score doesn't shrink the equity cushion when you're doing a hard money loan with some of these lenders. The lender's risk is going to be secured by the hard assets, which is why we call them hard money loans. As long as there's enough value in the property to cover their loan, if things go sideways, they're often willing to take the risk. Now, they do have some stipulations. They typically don't want to do a lot of business directly with homesteads, meaning it's a property that that is something that you live in primarily. One of the reasons why is that it's harder for them to foreclose on your the only place that you have to live. Okay. Um, but they are very flexible about a lot of other things. This is going to be the secret weapon that some savvy investors are going to use, because while others are waiting weeks or months for a bank committee to review the pristine tax returns, the investor with a hard money relationship can make a cash equivalent offer and close in days. Now, they've accepted that this access and speed will cost more than what you're going to get from the bank, but they've calculated that the opportunity and the value is far outweighing the cost of the capital. And that's what we call the cost of doing business. Now, I'm going to be honest with you. You might see bank loans that are hitting you like 6 and 8% on a property. You might see a hard money loan that's hitting you like 14%. It's not favorable to the average good credit score, good payment history, large asset holder. But it's favorable to the guy that just barely made it, doesn't quite have enough, and just needs a little oomph to get started, to get over that line. So if asset based lending is the good news, then the loan terms are the cold, hard reality of what you're paying for that access. This isn't going to be a 30-year mortgage with a comfortable payment plan. This is going to be a high stakes short term tool, typically 12 to 18 months. And you need to understand every single part of it, which is why we're talking about a bridge, meaning from the time you find the asset to the time that you find the money and you have the money that's supposed to be inside of this short window of time. So let's talk about term lengths. A bridge loan is a sprint, not a marathon. So we're not talking 10 or 20 years. Typical bridge loan terms are anywhere from 6 to 24 months. Like I told you, 12 to 18 months. For larger commercial projects, and we're talking about, when we say commercial projects, we're talking about a million, 10 million, something like that. Terms can sometimes extend to 36 months, but that's less common for smaller deals, right? This incredibly short window is by design. The lender is not your long term partner, they are a temporary solution. And this short term puts immense pressure on you to execute your exit plan. Now, real quick on a side note, as we're getting into this, from the perspective of the borrower, that's what we're covering today. And I'm actually going to talk about these bridge loans again, I believe, next week from the perspective of the lender. Because you got to understand that if you've got the capital to cover these bridge loans, you've got people that are borrowing money from you in a short period of time, paying you back with immense interest, and then you're able to recycle that money back into somebody else's deal where you don't have to go through the stress of balancing the budget, of making sure that the other people close the deals, that people are buying the properties and all this, that, and the other. All you have to do is make sure that you have the money available to validate the loan that they're requesting. So we're going to be talking about that side of the bridge loans, I do believe, sometime next week when we cover bridge loans again. Now, the next thing we're going to be talking about, and this is going to be a big one, it's going to be the interest rates. Prepare for stickier shocks. As of mid 2026, for borrowers with challenging credit. Challenging credit is when you're below 680. Challenging credit sometimes can be when you're below 630. You're really suffering when you're at a 600, right? You're going to expect above market average interest rates from 9 to 14%, or sometimes even higher, depending on how bad your credit is, how bad your payment history is, how much asset you have invested in the situation, how much capital you have available, what your payback plan is, right? All that stuff plays into the percentage yields. Now, some hard money specialists quote rates at 12% and up for most deals with very poor credit, 500, 550, 580, right? And this is going to be the cost in the speed versus cost trap. So I know that there was a guy that was jumping onto the show a month or two ago that was saying that they were helping people lock in houses with like really low credit scores, 550, 580, whatever. This is one of the ways that you can do it. You are paying a massive premium for speed and for the lender to place less weight on your credit history. Now, then there's going to be the structured payments because do you think that they're going to throw this money at you and wait until you get money? No, 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 no. Most bridge loans are going to be structured as interest only payments. This means that your monthly payment doesn't go towards paying down the principal at all. You are only covering the interest charge. So on the surface, that might seem great to you, but it keeps your monthly carry costs low. A $400,000 loan at 12% annual interest would have an interest only payment of $4,000 a month. If you can afford that $4,000 a month, then you might feel like this is a good spread. But that is a deceptive comfort because at the end of your 12 or 24-month term, the entire original loan amount, which is the full $400,000, comes due all at once, and this is called a balloon payment. And it is, without a doubt, the most dangerous part of the bridge loan. So you have to come up with the entire principal in a lump sum because it's going to be a financial cliff. Now they do have opportunities to extend the loan where they up from 12% to 18% or up from 14% to 24% or whatever because you haven't gotten that 400 grand yet, but that means that you're paying more interest over time to maintain the property. As long as you're giving them interest on the principal and you still owe them the principal like a loan shark, they're gonna try to work with you in some situations, but they're eventually going to call this loan for you once you have passed your original contract date. So your entire strategy must be built around being able to make this massive payment on time, if not early. He said, great way to stay poor. Well, if you're doing it wrong, it is a great way to stay poor. But you got to understand, okay, so check this out. September 2025, I gave you guys all the tools and resources that you needed in order to fix your credit. Challenge all of the outstanding charged off accounts that have been lingering on your account for more than 7 years, because if you don't say anything, it'll stay there, continuously hurting your credit. Then challenge anything that can't prove that you actually owe anything, which will remove a lot of stuff off of your credit report. And then you'll just be stuck with the stuff that happened over the last 3 years where they can definitively prove that some way, shape, or form that you owe somebody money, right? Now, I told you guys there's two ways that you can go about doing that. You can either let those accounts linger, or you can do payment plans with them and pay them off. By paying them off, it will boost your credit score, not nearly as much as it would have had it not charged off, but it would boost your credit score that you've closed out these debts. What you would need to do from that point is to have a good payment history for the next 2 years. That's 24 months to fix your credit. It's not an overnight process. Your credit score could be tarnished 640, 675, where you have the last 2 years of no missed payments. You might have one or two low charge-offs, some high student loans, and no medical records because Donald Trump passed the laws and took off the credit reports, no medical records holding you back. All right. Now you go talk to a hard money lender, and this isn't for like a first-time home buyer, I'm trying to buy my house kind of thing. This is I'm trying to buy a rental property or I'm trying to fix and flip a property in real estate and try to make me some extra cash. Now, let's say, Stephen, you found a $170,000 property. It's a distressed property. We call them distressed properties because it's not a ready to move in property. It needs some stuff to be fixed in it before somebody can move into it. You can buy that property, but you don't have enough money. So, because your credit score isn't good enough, you can't get the money from the bank. You go to a hard money lender, and that's why they give you that 18 to 24-month situation. Why? Because it is typically 1 week of repair for every $10,000 worth of damage on the property. So you need $50,000 to fix up this property. You need about 5 or 6 weeks to fix up the property. If you're closing on the property, it typically takes 2 weeks to close on a property if you've got cash on hand. And then it's going to be another 6 weeks after you get control over the property. The house is not going to sell inside of the first 6 weeks all the time. If you're trying to do a fix and flip, the house might actually take another 6 months to sell. So you had 6 weeks, which is a month and a half, plus 6 months, which is 7.5 months. House is sold. Now, if you bought it at 170, 175,000, you put 50 grand down. You got that from the lender, right? The hard money lender. They lent you, say, 200 grand because the house sell value would have been like 300 grand, right? So they gave you half. That's 50%. It's not a problem. After I finish putting 50 grand into this property, light repairs, it'll be worth 350, 375, whatever, right? You sell it for 300 grand. You owe them 200 grand plus interest. Let's say 240, 250 with interest, right? But you've been paying the interest month to month because off of 200 grand, if you were only paying the interest, you might have been paying like $2,500 a month on the interest itself for the 7 months. Then when you sold the house, you just give them the 200 that you owe them and you keep whatever's left. Now, if you sold the house for $150,000 more than what you borrowed, you gave them $50,000 worth of interest plus the principal, you still made $100,000 profit. Now, because you made $100,000 profit, you don't necessarily need to use that hard money scenario a second time. You have $100,000. You can walk into the bank this time around and say, hey, let me borrow from you this time. I not only have a property with a clear deed to it, I also have 100 grand. Even with bad credit, the bank will work with you because you're going to actually have whatever they're going to loan you is going to be 100% backed by your assets. So if you've got now a 300, well, actually, no, you sold the first property. So now you only have 100 grand. So if you got 100 grand, you sold the first property, you got 100 grand, you want to buy another property and you want to flip the other property. So let's say you got another property that you found it's 175 grand. You want to put 50 grand into the repairs. So you're going to finance the property for put 50 grand towards the 175. The bank is going to give you the other 125 grand. That's way more than 20%. They're going to say yes to that shit. They're all right. We're going to sell you. They're going to help you with selling this house or buying this house. You're going to buy the house. You can turn that one into a rental property. You put the 50 grand into the repairs. You fix up the house. You can then use that. And a lot of times you can shave off a little bit because of the buyer tax credits for any necessary repairs that are happening. Then you take that property, turn it into a rental property, and you look at how much you have to pay for your mortgage, which probably going to be under under $1,000 a month. That's the mortgage on the property. You put a tenant into the second property, and now the tenant might be paying 1,500, might be paying 1,800, and you take what you owe the bank, and then whatever's the difference, that's going into your pocket. Now you're making a $700 a month profit. So technically, Stephen, if you do it right, it's not a way to stay poor. If you do it right, it would be a way to stop being poor. Because if you find a good distressed home that you can fix up and sell, and it would have to be in a market that people are paying attention to the properties, right? And in that dynamic, you would be able to use a hard money loan the first time, pick up the first property, and then use cash up front to get the second property. You could preferably decide to say, well, hey, I'm gonna go back to that same hard money guy and say, hey, I got 100 grand this time. Front me 300 grand on two properties, right? And we'll work it out that way. There's always another way, but since you were good about coming through for them the first time, the second time it's going to be easier for them to front you money for your deals. Yeah, they're making way more money off of you than what the bank would be making off of you. But if the profit that you're getting is way higher than what you're giving them, that's the cost of doing business. But if you fixed your credit, you've got good payment history, you haven't had a bankruptcy or foreclosure in the last 5 years, then probably, well, foreclosures they'll probably look away from. But if you don't have a bankruptcy sitting there active, because you can always throw a house into a bankruptcy and prevent people from collecting. So if you don't have an active bankruptcy, right, a hard money person will work with you when a bank won't, and that fixes your ability to improve your financial position in real estate. Eventually, if you took the information I gave y'all September last year, which is like almost a year ago now, and you put that towards boosting your credit score and improving your payment history, you can find yourself more qualifiable for a lot more payment options. I know there are a lot of people right now that are just struggling with that $7,000 line of credit, afraid to get a cash loan from the bank to offset their credit cards because they don't want to have more debt. But if you work on your credit score and you've been doing good payments for this period of time, where they can say, okay, well, this 5 grand will front you this 5 grand. That'll allow you to pay your credit cards down, which will boost up your credit score. And now you're going to pay 225 on the loan. As long as you got the 225 a month to cover the loan, there's no problems, right? And you could effectively use, because a revolving line of credit, guess what that does? That boosts your credit score. And if you're doing a 2 year revolving line of credit, that's going to be a lot more beneficial to your credit score than a 6 month buy now, pay here, or buy here, pay here, buy now, pay later, or whatever scenario for like the next 6 months on $500, right? $5,000 over the course of 2 years looks way sexier on your credit score than $500 over the next 6 months. Now, let's not forget about the fees, because on top of high interest rates, you're almost always going to pay the organization's fees, often called points. 1 point is equal to 1% of the loan amount. It's common to see fees ranging from 1 to 3 points, so which is 1 to 3%. So on that $400,000 loan, you could be paying an additional $4,000 to $12,000, because that's 1 to 3% of the $400,000 loan plus the interest. So the $4,000 to $12,000 that you have to pay right at the start, adding in appraisal fees, legal fees, and other closing costs, and the total cost of your first fast cash can get even higher. So you have to calculate that into your request, right? So when you put it all together, short term, high interest rate, interest only payments, and massive balloon payment, you start to see the true nature of the beast. You're stepping onto a financial treadmill that is moving very, very fast. And if you're not paying attention to what you're doing, you can trip and fall and hurt yourself. Now, we're going to get into the deep mechanics here. So if you're finding this breakdown valuable, it's clarifying how these high stakes loans really work. I want you guys to do me a favor, hit the like button if you haven't done so already, subscribe to the channel if you haven't done so already, and continue to mash those reaction buttons. It's going to tell the algorithm that this is the kind of depth that provides that financial education that people are looking for, that they didn't even know was out there. And it really helps the channel. So Let's go ahead and start talking about the seductive part of the trap, right? How they get you funded in days instead of weeks. The single biggest selling point of a bridge loan is the speed. While a traditional bank loan plods along, taking months or more, a bridge lender can often get you to the finish line in a fraction of that time. And maybe they can close in 7 to 14 business days under the right situation. In rare high stakes situations with a perfectly prepared file, some specialized lenders can even close faster than that. But that speed comes at a premium. How is this even possible? Well, it goes back to asset based models. Since the lender isn't doing a deep dive forensic analysis of your entire financial life, the documentation process is radically simple. This is often called the light doc loan. Doesn't mean that there is no documentation. It just means that the documentation is focused on the assets, not you. So instead of demanding 2 years of tax returns, months of pay stubs, and detailed profits, and especially if they're looking for profits and loss statements, a bridge lender's checklist is short and to the point. They need a purchase contract, which you should have if you're asking somebody for money. A preliminary title report, which you should be able to acquire if they're trying to send you to sell you the property. And most importantly, a valuation, often a formal appraisal of some sort, which you should have already done if you're trying to acquire this property to confirm the property's value. And then they're going to calculate their loan to value. That's it. Their underwriting process isn't about judging your character or your past abilities to manage debt. It's a simple three-part question. What is the asset worth? How much equity in the deal to protect us? And how are we getting our money back? But if you have a good payment history, that's what bridges the gap when those investment gurus say, "Oh, you can have bad credit and you can use somebody else's money and go directly into real estate and start flipping properties and making money, and all you need is a good payment history." That's what the fuck they were talking about. Yeah, if you have a good payment history, that means you can pay the interest only payments on time because you've been paying everybody you owe on time. That gives you more security in this hard money loan. Even though your credit is bad, even though you got a lot of stuff from your past, the fact is, over the last couple of years, you haven't missed a payment, which means if you do business with them, you're not likely to miss a payment because the process is so streamlined. Decisions can be made incredibly quickly. And this speed is going to be intoxicating. So when you're in a high pressure situation and a lender says that they can wire you hundreds of thousands of dollars by Friday, it feels like a miracle. But this speed can also be a trap because it creates a sense of urgency that can cause you to overlook crucial details. The excitement of getting a yes so quickly can overshadow the astronomical cost of that yes. That's the part that you have to factor in. How much does the from I get the money till the time I get the money back cost me? You might be so focused on securing the deal that you don't fully calculate the punishing interest payments or the monumental task of facing that balloon payment. And one of the things you'll find when a fixer flipper is selling a house, they bought it, they started renovating the house, they put it up for sale. They typically drop the price significantly and then they lock in at a specific amount and say we can't go no lower. The reason being is because they're trying not to take the house at too much of a loss. The house has been on the market for a year. They were supposed to have this deal done within 18 months. It's not done because it was 6 months under repair and a year on the market. That's a year and a half. You as a buyer can come in and talk them down enough where you can get the house at a better price, typically 15 to $20,000 less than whatever they're asking for, and they're going to take whatever they can get because they're trying to pay off the lender. And for you, that closing could take 2 months. And the reason why that closing could take 2 months is because in order for them to get the title, they've got to pay the lender. Then the bank will give them the money. They're not going to give and that's what a broker is for. They're not going to give the the money to the seller so that the seller can get the title from the hard money lender, because the hard money lender is going to hold the title until you give them their money back. That's part of the collateral, right? So the speed to solve your immediate problem is going to be there, but it can lure you into a much bigger one size fits all problem down the road that you might not be able to solve. So we've treated the bridge loan as a powerful but expensive tool. Now we need to talk about what happens when that tool breaks. And this is where the trap springs shut. Now you have to understand that these failure modes occur before you even think about taking this kind of debt on. And typically one of the reasons why people are afraid to take action in this manner is because they are afraid of the negative fallout. Like, what if nobody wants the house? Somebody wants it. Man, there's a house next door to me where everybody killed themselves in a house like Chris Benoit. That house sold for $250,000. Somebody's going to want it. Didn't me if I'm going to buy a house that's haunted that looks like OJ's house, covered in blood and everything. Like, no, but somebody will buy it. They'll take the carpet out, polish the walls, paint over the blood stains, move right in. Some people don't care. So you can't think to yourself, well, if nobody wants it, you have to think, can I afford to hold down the cost, the holding cost until it sells? That's the question that you have to ask yourself. So the number one killer that exists is going to be a exit strategy failure. Not a lot of people. Everybody sees a good deal and they see how they can get themselves into the deal. They don't see how to get themselves out of the deal. And getting out of the deal is not running from the deal before the deal resolves itself. It is making a profit off of the deal. I had a buddy of mine that I talked to. He had fantastic ideas on a regular basis that he would talk about hypothetically this, and this. And yeah, they're good ideas on paper. But how do you get that idea to a profit? Even something like doing this podcast, it's a fantastic idea. So many people, if they found out that this was here, that they would probably come here quite often and learn some stuff so that they could actually find themselves in a position where they don't have to financially struggle as much as they used to. But for this to be a successful 2 million follower podcast, I have to see it to the finish. And the finish is not at the end of the year. The finish is when it is a revolving high volume podcast that is being watched all over the world. So I got to keep doing it until it reaches that point. And that's not what people pay attention to. They think, well, an idea is a good idea, short-term gratification. I'm going to get into it, short-term effort. I'm going to get something out of it. And if they don't get effort out of it, or if their effort doesn't get a profit out of it in a short enough period of time, they abandon the idea. All of the money and time and effort that was invested into it becomes a financial loss. They just charge it to the game. Well, I tried it and it didn't work. I started this thing and it didn't work. If you don't quit, it will work eventually. You just have to change the way you address it. You have to change the way you get into it. So when we start talking about exit strategy failure, you have to remember that every bridge loan is taken out with the assumption that a future event will happen to pay it off. This is supposed to be your exit. Typically, selling the property or refinancing it with a cheaper long-term loan. And that actually is something that we didn't talk about in the beginning of tonight's show. Because if you pick up the property with a hard money lender, and remember I told you guys, that there's like 8,000 financial institutions across the United States, well over 8,000 financial institutions across the United States. I told you guys to have at least one bank account and one credit union in every state. That would be at least 100 financial institutions under your control. If you got a hard money loan on a property, right? And you did the renovations, the value of the property is higher, where you might have bought the $175,000 property that could have sold for $200,000, and you might have got it for the 175. You might have got it for $100,000 off the guy and put up an extra 50 grand, or you might have got it for 125,000 and put up the extra 50 grand, did the repairs, but now it's worth 350. Well, if you owe less than 50% of the value of the property, and then you go to a bank and say refinance this property, bank more than likely will do it. And if they refinance the property, you pay off the hard money lender, and now you can turn it into a rental property. I mean, unless you use like an FHA loan that requires you to live in the property for 12 months. But if you use a regular bank loan, or in the credit loans, credit unions are going to have cheaper interest rates than banks. But if you went to a regular bank loan or a regular credit union loan, they'll finance or refinance your house for you cheaper than the hard money lender. So you'll go down from the 14% down to like 6 or 7%. And you'll go down from having to pay $4,000 a month on just interest to now paying like $1,000 a month for 30 years on a mortgage. So that's another way out where you can still keep the house and walk your way out of the hard money thing. And you don't have to wait for the end of the contract in order to keep the house. You can actually buy the house, uh, hold the house for 6 to 8 weeks, refurbish the house, renovate the house, reappraise the house, get a higher value on the house, and then take that higher value, go to the bank, refinance the house, and then pay the guys back, where you would have only had to give them like 8 grand from the time you started. But the bank might give you 200 grand on the 175 that you borrowed from them, which means that you can give them back their 175 grand after giving them the 8 grand of interest only, and still be able to pocket that 200 grand, where you just reimburse yourself on everything that you borrowed from these people, and potentially have an extra 50 grand set aside, put a tenant in there, got the tenant paying the rent out of the 50 grand that you out of the 50 grand extra that you got in the bank when refinancing this property. That 50 grand can help you pay the monthly payments on the mortgage until you put a tenant in there to pay the monthly. So you might have the property not actually be rented out for 6 months after you do all of this stuff. But if you got an extra 50 grand there and you only owe the bank $1,100 a month, you can give them that $1,100 a month out of the 50 grand that was left over from the 200 grand that you refinanced the house on. Because you don't refinance the house dollar for dollar on what the other guys want. You refinance the house on the 65 or 70% or 80% of the actual appraisal value of the property, the after repair value, the market value of the property, which ultimately, for a 30-year mortgage, that ultimately gives you a better opportunity. So that switches back to what you said earlier. Great way to stay poor. This is actually a great way for poor people to stop being poor, because if you do this right, and you would have to set it up first, because like I said, you got to have your pay history in check. You have to have all of the unnecessary stuff taken off your credit report. You have to have all of the stuff set up in a way where you actually would otherwise qualify. If you had an asset already, you would otherwise qualify for the bank loan or the credit union loan. And credit unions are typically going to do more for their members than what they would do for somebody that's not a member, which is why I told you to get credit unions. But you also have that scenario where you can now double back and say, well, now I'm going to do the hard money loan, get in there, get it done, raise the value of the property, and then go to my credit union and get me a really cheap loan, half the price of the hard money loan. And now I'm going to put a tenant in there, because the loan doesn't say that you can't have somebody renting a property unless it's an FHA loan or a VA loan. But like if it's a credit union loan, the only thing they say is that you can't sell it to anybody else. You can't give it to anybody else because they put somebody else on title. They call a loan. So you hold the loan as a primary owner, and boom, it's done. Now you've got a tenant that's paying more to you for rent than the cost of the refinance. You got reimbursed from the refinance. What you gave the hard money lenders was out astronomically high, but it's the cost of doing business because ultimately you offset your initial expenses onto the customer over time. You will have to have something walking into this, but at the end of the day, you'll be walking away with more than what you came in with, and that's not what the real estate investor gurus tell you. But what if you don't have an exit plan? What if the house sits on the market for 6 months or longer, or even more than what you would expect it to? What if renovations uncovers foundation issues that doubles your budget and doubles your timeline? What if you get the property ready to finance, but because of your credit, the bank still says no? That happens. And this is going to be the moment of pure terror. Your 12-month term is going to be up, right? The massive balloon payment is going to be due, and you don't have the money. The lender who was your friendly partner when you signed the papers is now your adversary. Their only goal is to get their capital back. Some contracts even have rate escalation clauses where your already high interest rate can skyrocket if you fail to pay on time. Ultimately, they will begin the foreclosing process if you don't get an understanding with them about how much extra time that you need, or if they're tired of waiting. If you're 6 months or a year beyond the original close date and they are not willing to give you any more time, they start working on a foreclosure process. And they will take the asset and all the money that the work and everything that you poured into the property, all of it will be gone if you don't have an exit strategy. The second major failure mode is going to be the slow bleed. And this is going to be where the sheer cost of the money slowly eats away all of your potential profits. Because if we run a brutal scenario, take out a $300,000 hard money bridge loan to buy a property that you plan to flip. Your rate is 12%, interest only. You have 2 points in organization fees. So that upfront fee is like $6,000. Your monthly interest payment is like $3,000. So let's say that your project, which you thought would take 6 months, ends up taking 9 months. Over those 9 months, you'll still have to pay about $27,000 in interest payments alone. Add that $6,000 in the original fees, you're at $33,000 in finance costs before you even account for other holding costs like HOAs and other such shit, utility bills and everything to that effect. If your project profit on the deal was calculated at about $50,000, it's now being slashed to just $17,000. And that's if everything else goes right. If the sale price is a little lower than expected, your profits can even vanish completely, or worse, you could lose money on the deal, all because you underestimated the corrosive power of high interest debt over time. Now, the final consequence is, of course, the foreclosure. Now, this is going to be the end of the line. If your exit fails and you can't make the payments, the lender will exercise their right to seize the collateral. So you will lose the property, all the equity you had, all the money that you invested, and all the work that you put in. It all disappears. So if you put up a few other houses and some cars and shit as collateral for this situation, yeah, they're going to take it all. That's going to be the ultimate price to pay for a failed high stakes gamble. So you're only supposed to be getting into these when you have solidified your out. And that's why I would say, well, if your out required you to have more assets at your disposal at your current credit score, your credit score does qualify for loans, just not the amount that you were looking for. If you were capable of bringing more collateral to the table, They may approve that exact same loan. That's when you do something like this. You do the hard money to get you the property, raise the value of the property. Now you have the increased collateral. That increased collateral now qualifies for the yes, where you might have been, for example, going into that $175,000 house, you didn't have enough collateral to get the loan because you needed $175,000. The house was worth $200,000, so that was too much with your current credit score. But if that exact same house only has $175,000 worth of debt on it, and that same house is now worth $350,000, there's $200,000 worth of collateral there. That extra collateral, the bank might say yes for the exact same credit score because you put an extra $100,000 worth of collateral or an extra $150,000 worth of collateral on that same property. The bank who originally said no would have said yes now. That's one of the things that you have to factor in, right? Now, given the extra risks, are these loans even a good idea? Well, yes, absolutely, but only for the right type of person in the right type of situation with the right type of plan. Using a bad credit bridge loan is like wielding a chainsaw. In the hands of a skilled professional, it's an effective tool. In the hands of a novice, it's a recipe for disaster. So let's draw a clear line between rational use and reckless use. A rational use case is if you imagine a seasoned real estate investor. They find a severely distressed property listed for like $200,000, but they know that with $50,000 in renovations, its after repair value or AVR will be a conservative $400,000. They need to close on the house in 1 week. They get a hard money bridge loan for like $250,000 to cover the purchase and the rehab. The loan to value base is low on the future value. The rate is going to be high, which is like 13%. The fees are another $5,000, which you should have on hand. And they know that their crew can complete the work in about 4 months. Now, their total finance cost for the 6 months, uh, 4 weeks of work, two for the sale, it's roughly $21,500. If they sold the house for the $400,000 asking price, their gross profit is $150,000. After subtracting all costs, they still walk away with a massive profit. For this type of investor, let's think about this real quick. If in the event that the timeline that they held the property was doubled and they ended up having to spend another $22,000 out of the $150,000 profit, they would still be able to walk away with another 130. They would be walking away with at least 100 grand, right? For this type of investor, the high cost of the bridge loan was simply a transactional experience. And this expense is going to be required to unlock the huge margin. Their exit strategy is going to be sound and their budget was realistic. That is a rational use. Now, also under this same exact example, with that extra $150,000 there, they could have, as soon as the property was finished, 4 weeks worth of work, they could have reappraised the house on week 5 and then refinanced it. And within 8 weeks, they could have pulled the house out of the hard money situation and only spent like $16,000 on the hard money individual instead of having to pay the $21,000. And they still could have remortgaged the property for 250 grand or uh, uh, 300 grand or whatever. And they could have found themselves, well, 250, 300 grand, where 300 grand will be closer to 70% of the after repair value of the property, but 300 grand will be 50 grand more than what the house was being hard money loan for. And instead of having a 13% interest rate, they would have a 6% interest rate. And because there would still be $100,000 worth of equity in the property, right? For somebody with a decent credit situation, they could find themselves refinancing the house, paying themselves 50 grand, and then turning that into a rental property, or using that 50 grand as a down payment to buy the next house. Steven says houses on the Detroit land bank would be perfect for this. Oh, of course. Any house that has been sitting somewhere for so long that the grass is overgrown on the property, the paint's all worn down, windows are broken out because the kids are throwing rocks on it, covered in spray paint. It's not a livable place. That's called a distress home. You're going to cut the grass. You're going to repaint the house. It does. You're going to replace all the windows. You might repaint the walls to get the spray paint off of the walls, fix the floor, stuff to that effect. It's still light repair, right? You're not changing out all the floorboards and rebuilding walls, but you're gonna undo the graffiti and then put the house up for rent or put the house up for sale. You can knock that back, right? And even with the current real estate investment laws that's just gotten changed, small real estate investor startups can buy one house at a time, up to 300 something houses, and not be blocked by the new laws. Big business can't buy 1,000 houses in a neighborhood and say, or 500 houses in a neighborhood and say, I'm going to do what I'm going to do. But for you, you can start up an LLC, real estate investment property scenario, and you can use that real estate investment property scenario to buy one house at a time and renovate it, rent it out, and then move on to the next. And the laws that have changed would not impact you, right? So if you said, well, in order for me to live comfortably in my life, I only need like 20 homes. You could pick up 20 single family homes under the current laws because they're capped at like 300 something homes. So if you have none and you buy one as a homestead and like five or 10 as rental properties, you can still do that and potentially get $500 a property as profit, which is $5,000 a month off of 10 properties as profit, $10,000 a month for 20 properties as profit, which puts you into the $100,000 a year range to own 20 properties, probably in your neighborhood, to just renovate them and rent them out, as long as you do it correctly. Now, incorrectly, a reckless case, we're going to talk about that. Consider someone with bad credit, small business that's struggling. They decide that the solution is to buy a new, larger location, convinced that it's going to attract more customers. Property costs $500,000. They get the bridge loan for $350,000 at 11% interest, and they have to come up with another $150,000 down payment. Their exit strategy is to get the bank loan in a year once the business is doing better. This is not a plan. This is a prayer. What happens? The business doesn't magically improve. The interest only payments of over $3,200 a month is a consistent drain. And after 12 months, their credit is no better than what it was before. And the business's financials are weaker. The bank rejects them for a refinance. Now the $350,000 balloon payment is due. They have no way to pay it. The lender forecloses and they lose the property and their entire $150,000 down payment. They used a high risk short term loan to try and solve a long term fundamental business problem. That's a reckless use. The dividing line is clarity and predictability. A bridge loan is rational when the value it locks massively exceeds its costs and when the exit is a near certainty. It's reckless when it's used to speculate or when the exit depends on hopeful assumptions rather than a concrete plan. Now, I can tell you right now, uh, you can see exactly how much your bank likes you just by trying to borrow $5,000 from your bank. If you haven't, if you haven't requested a credit card in the last 6 months, it's not going to hurt your credit card. It's not going to hurt your credit score for them to do one hit on your credit score to see if you would qualify for a $5,000 loan. And why do I say see if you qualify for a $5,000 loan? Well, If you can't qualify for a $5,000 installment loan, you're not going to qualify for a $150,000 house loan. You understand? You get the $5,000 installment loan, you can use it to kind of benefit yourself because think about this with a $5,000 installment loan, a lot of the times you have a lot of smaller unpaid charge offs on your credit report. You can either use that $5,000 thing to you can either use it to throw it in your brokerage account and get you some money, but $5,000 isn't going to get you a lot. Even at 20%, it's only going to give you $1,000 a year, and your payments on that is going to be more than that. But you can use it to pay down your credit cards, give you some room so that you're not paying so much money in interest on your credit cards. You can use it to pay down other charge offs, and you can negotiate them to take like 50, 60% off, and then you just pay certain things. A lot of the times they'll talk you down to paying the principal and shave off all of that unpaid interest just so that you can pay them some of what you owe them. And that will take that off of your account. And now all you have is the one installment loan that actually looks good on your credit report, and all of those negative charge offs can come off. After you've paid off that $5,000 installment loan, you can actually then go back and get a $10,000 installment loan, right? And you can use that $10,000 installment loan. There's another way that you can use it. You can use it to get you a secure credit card. Some people would say that that's a bad idea because you now owe so much money per month on the credit card. But if you're boosting your credit score over 700 so that you can qualify for a $500,000 loan without having to do the hard money thing, if you got the money to pay for it, that's one strategy that you can utilize. But you have to understand that if you can't get a $5,000 loan from your bank, you can't get a house from your bank. You understand? Your financial paperwork got to be right. Right. Steven says, I just borrowed from the bank, but not $5,000. I know. You can get $1,000 or $1,200 or $2,500 a whole lot easier than you can get $5,000 and $10,000. They start asking the more money you ask for, the more questions they ask, right? The more strict they are. But if you've been like with the credit union for like a year, 2 years, 5 years, and then you go over there and you say, hey, I want $5,000. That's sometimes the quantity of money that people ask for a down payment on a car. If you can get that, then you're headed in the right direction. And this is how this before you start looking for a real estate deal to close on, you can test your credit worthiness by doing shit like this. And you can use that money beneficially to yourself. Because I do believe that a $5,000 loan under the right circumstances might run you about $250 a month. Now, if you've got a bomb ass portfolio and you're adding that $5,000 onto your stock portfolio and you're taking that $250 a month out of the dividend distribution and you're paying back the loan out of your brokerage account, you could potentially borrow the money from the bank, tell them you're consolidating debt, and then you take the money and then you put it into the brokerage account, then you just pay off the loan. And then once you pay off the loan, you still got the principal. And since you paid off the loan versus the taxable income kind of wash each other out, and you're ultimately in a position where you're not actually taxed on the money that you profited off the brokerage account because you paid off the debt. Then you can go back and grab you another loan. That's another way that you can leverage loans to make profit. But you're looking at the interest rates of the bank loan for a cash loan because the interest rates for a cash loan is sometimes significantly higher than an asset-backed loan. And when you start thinking about if they start offering like 18 and 22% interest on the thing and you're making like 15 to 20% return on investment, you're losing 2 to 8% return on investment. Sometimes you're calling that the cost of doing business if you are using someone else's money to turn a profit. Not a lot of the big time money making guys are going to say, oh, well, that's a good investment if you're spending more than what you're making in order for you to have this extra chunk of change. Well, shit, 8% fee to get an extra 5 grand. I can't put 5 grand, right? Because this is 8% per year, right? I can't put 8% of 5 grand anywhere. 5 grand in 24 months, right? Because that would be a total of 16% of the value of the 5 grand, which is not 5 grand, right? Even at 10%, that would be $500 a year that I would pay to get 5 grand. And if I was able to pay that whole 5 grand off, shit, for $1,000, I got $5,000. That's buying money. That's the cost of doing business. But that $5,000 will forever turn me a profit. Now, can I recoup the loss on that? Yeah, year over year, if I keep that principal and it continues to give me the $1,000 a year compounded interest and everything to that effect on my original investment, 2 or 3 years after I've given that first grand to get the 5 grand, I would have made back the grand that I gave up. But that's long-term investment strategies. If you're thinking about it in the short term, from the time you get the loan to the time you pay off the loan, yeah, you're going to be thinking about how you're spending more than you're making with somebody else's money, not your own. Now you also have to realize that after using these more difficult, more costly ways to get the principal into your pocket, you realize that you no longer have to use these methods going forward because you've already collected the principal. Now that you've got the principal, you can do things like leverage the principal against certain assets. So if you leverage a brokerage account to buy a real estate property, and then you take the dividends and you pay on the loan. If your dividends are $3,000 a month and they're telling you that you got to pay $2,500 a month towards the loan, you're not hurting on this type of deal, right? That's the kind of success that the wealthy has because they have more than just real estate. They have gold, silver, Bitcoin. They have brokerage accounts. They have real estate properties, rental properties, and properties for sale. They have multiple facets of assets that they hold where they don't just buy stuff for the convenience of buying it. They buy stuff that is supposed to turn them a profit over time, right? And when you start thinking about should I buy or should I not buy whatever it is that I'm looking at, you have to ask yourself, what's the financial profit of me buying this? If I'm not going to profit off of buying this, then it is a liability. And now you have to ask yourself, can I afford this liability? Not can I afford to buy the item? Can I afford this liability? What's the difference between can I afford the item and can I afford the liability? Well, if my goal was to turn a profit and I'm about to spend money and make no profit, is that beneficial to me? If the answer is no, then it's not going to work. Now, if I need this item in order to accomplish a larger task where that task is beneficial to me, this item doesn't necessarily pay for itself. It is still a liability, but it is the ends that justifies the means, which is I had to pay for this liability to accomplish this other larger task. For example, buying a tool, liability, but buying a tool to fix your car, the benefit is that you fix the car instead of paying somebody else to fix the car. So the money that you saved on an external mechanic is the profit that you get from buying the tools to fix the car yourself. Right? That's when you ask yourself, can I afford this? Is this inside of the scope of the things that I want to pay for? Right? Now, if you believe that your situation falls into the rational use categories, you still need to proceed with some extreme caution because while not unregulated, the world of private and hard money lending can be less standardized than consumer banking, and the quality of lenders varies dramatically. So, for owner occupied homes, specific customer protection rules often apply, right? He says, I'm not going to lie, I'm not looking at a Benz knowing that it's beneficial, but trying to justify it Buy this will raise my credit score. Yeah. Um, you're not buying a Benz because it is not financially beneficial. You're buying a Benz that's not going to boost your credit score, and using this type of mentality will improve your credit score. Trying to justify whether or not you should even finance a Benz will determine whether or not, because when you think about, like I told you before, prestige over practicality. Financing a $10,000 Nissan Versa puts $10,000 on your credit score. Financing a $100,000 Benz puts $100,000 on your credit score. The $10,000 Nissan Versa, 7 years, probably got you paying $100, $125 a month. $100,000 Benz, 7 years, probably got you paying $1,000 a month. The difference between the two, prestige, everybody's gawking at your Benz when you roll up. All your friends want to ride, high five. You travel with an entourage. Nobody's putting gas in your car. Nobody's helping you pay for maintenance. Nobody's helping you pay for the insurance. Versa, practicality. Everybody will follow you, but not too many people really want to carpool because nobody wants to be seen in a Versa, right? But you can afford the car, you can afford the interest, you can afford the insurance, you can afford um the insurance and everything like that. The fact is that you can actually walk away with this, and it's not going to be a burden on you, right? Now, with a Benz, if you owned it cash up front, you could probably get a title loan on it or take out some type of alternative loan on it and use it as an asset that can generate capital. Because even with a car, depending on the year, make, model, if you own it, you can leverage it for like 40% of its value and get some cash to do something like go and do a real estate job. But it really depends on how good the job is. You say it's a used $9,000. Well, if you're going to go to for a Benz is a money pit financially for repairs, so I'm going to tell you that it's not a good idea to go and buy a Benz used. It's not a good idea to go buy a Benz new, but if you're going to buy a Benz, it will better be certified pre-owned under $125,000, 125,000 mile warranty, where anything that breaks on it, the dealership is going to fix. That's the first thing. Buying a $9,000 Benz is a problem. It's not like buying a $9,000 Cadillac. Special shout out to OG Kicks. It's not like buying a $9,000 Cadillac. It's not like buying a $9,000 Ford or a $9,000 Toyota, um, or a Nissan of any kind, Mitsubishi or something like that. Even a Subaru, a $9,000 Subaru would make more sense. And reason being is because the maintenance on the car is going to cost the owner of the car more money than the car is worth. Typically, luxury cars are traded in when they start costing more money to fix them than their value. So when you buy it, even if it's in reasonable condition, like it looks good and it runs right, the dealership usually goes the computer, taking off all the check engine lights off of it. You take it on a test drive where you're only going to go around the block with it. You're not going to notice any mechanical failures in the vehicle because it hasn't triggered on the sensors yet. Now, you're going to get in this car, you're going to drive it. Within 90 days, the check engine light's going to come on. It still runs, but you got it in an as is condition. You're not going to fix it, you're going to wait. At some point, you got to bring it to the shop. The mechanic's going to tell you how much it costs, and how much it costs will be 3 times more than fixing a Toyota. That's when you're going to realize that this fucking Benz looks nice, but it is fucking expensive to fix. You got some Mercedes Benzes, depending on which one you get, they might have a once a year tune-up cost of $2,000 fucking. Not every 3 months, not every 2,000 miles, once a year, but it's $2,000 fucking the one time it happens. And what some people might do is they might get that Benz and they might be using that Benz and be doing that tune up thing. And then eventually they realize, I don't have the $2,000. The car might be 10,000 miles away from its scheduled tune up. They trade it in, get something cheaper, fucking Lexus or some shit like that. Now, weird thing is, you pick it up, no problems, right? Dealership puts the car on the road, they guarantee you everything. It takes you 6 months to put 10,000 miles on that Benz. Then, when it's time for a fucking oil change, they tell you $2,000. Now, you paid $9,000 for the Benz, but the fucking oil change it cost you $2,000. Now you're like, man, fuck, I don't have $2,000. I'll change the oil myself. Then, when you try to call up underneath that motherfucker, you find out it's not as easy as it looks. Now I see why they charge $2,000. Now you've got a $9,000 Benz with a $2,000 repair bill. You don't have the $2,000 for the repair bill. You're going to drive the car until it breaks, or you're going to park the car and go back and use that Toyota because you don't have the $2,000 for the repair bill. So you're looking at the Benz. You didn't buy the Benz. I'm going to tell you right now, uh, you don't even have to talk to the dealer. Get the VIN number, the make and model of the vehicle, do a Carfax on it, make sure it hasn't been crashed yet, and then look up the service costs for standard repairs on the vehicle. You get the mileage of the vehicle and see what the recommended service costs are at that particular mileage. Then, when you do go talk to the dealership, find out if those repairs were done already. If they weren't, I don't want it. If they were, and you've got paperwork to prove that those repairs were done, the general maintenance on a vehicle was done, I might take it. But then I also got to ask myself, if they just did the $2,000 oil change and the $2,000 oil change is going to be needed in the next 15,000 miles, am I going to put 15,000 miles on it in the next 12 months where I got to do that $2,000 oil change? Or am I only going to use this as a weekend driver? And if I'm going to hold the Mercedes Benz, knowing I've got a $2,000 general maintenance bill that's mandatory on the car every 12 months, then am I going to put $200 a month aside for that $2,000 repair bill? Can I afford to put that kind of money aside? If I can, then I'll get the car. You got to realize, okay, back in the day, Stephen, we could pull up in the car and whatever business deal that we were doing, everybody was outside and saw us pull up in the car. We look successful. We talk successful. We negotiate successfully. Success hovers around success. 2026, a lot of the times you're talking to people on a computer like this. Nobody knows what car you drive. A lot of the times, everybody's already in the building. If you got there late, nobody knows what car you drive. If you got there first, trying to show your value in the deal, nobody knows what car you drive. Why? Wealthy-minded people don't always drive luxury cars. It's because practicality is what you're supposed to be buying. Broke-minded people will buy a luxury car at a cheap price because I can't afford a brand new luxury car. I ain't gonna cap. I got a Cadillac, but I didn't buy that Cadillac because it was a Cadillac. I bought a Cadillac because that motherfucker was the cheapest car on the fucking lot. And it didn't let me down for 3 fucking years. I paid $4,000 for that Cadillac. Half the price of your Benz. I paid $4,000 for the Cadillac. And wait, I had a breakdown, and I paid $2,100 on a breakdown, which is $6,100, and that Cadillac's running strong since 2023. You're about to spend $9,000 on the Benz, and you don't know what's wrong. If I put $2,500 on the sunroof, I would be right at $7,600, which is still less than your Benz. I know. You said I just wanted to pull up on campus to impress women to keep it real. I know, and that's the reason why I have this conversation with you. That's why, because we only got like 12 pages left, 14 pages left on today's show. Uh, that's why I'm having this conversation with you. If you are driving a Benz on the college campus to attract gold diggers, because that's what you're going to attract. And truthfully, you can attract those same gold diggers with a Prius. You can attract those same diggers with a Honda Civic. You can attract those same gold diggers with a Grand Caravan because bitches travel in groups. And if you've got a van, you can put all the bitches in the back. So you don't necessarily, you can get a Voyager, which is cheaper than a damn Benz. And because it's got the power doors that slide open, it's fantastic for hoes on a campus. You can do that. It'd be cheaper, more practical. But the thing is, though, if you're impressing girls with your Benz, you would be car rich to them, but you would still be unnecessarily financially burdening yourself because you have to cover the maintenance yourself. Now, you could have still accomplished the same uh, 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 results just by joining a fraternity. It's not. Hold on. My guy says if you have to ask, it's too much. At my age, it's just transportation. I would rather invest in getting away from people than. Special shout out to John. That's what I'm trying to tell you, Stephen. I'm not putting that kind of money into a vehicle just to pull up on bitches and be like, oh, I got a Benz. Because one, you're now trying to impress them based on social status. So if your Benz is parked next to a newer Benz, is she going to get in yours or is she going to get in his? If your Benz is parked next to a Nissan Maxima or a Fiat, yeah, you got a Benz, right? But if you've got a Benz and your Benz is sitting next to a Hellcat or a Demon, I mean, they're probably going to get in the fucking Hellcat. So if you're trying to impress a chick, then you're buying a car for the wrong reasons. You should buy a practical vehicle because ultimately the right women that should be hanging around you should be the kind of women that are going to look at the fact that you made a responsible purchase. So a Toyota Camry, a Honda Civic, a Ford Focus, a Ford Fusion, a Volkswagen Jetta. These are the kind of cars that won't let you down. These are the kind of vehicles that will last you 5, 10, 20 years after you buy it, even if you bought it used. So you can buy you a 2019 Versa. You can buy you a 2019 Jetta. You can buy you a 2016 Fusion and still have somewhat of a semi-luxury look to it, and it'd be way cheaper than a Bentley. It'd be way cheaper than a Benz. And the repair costs would be way less. And the insurance costs would be way less. I gotta tell you right now, my Cadillac's like $93 a month for the insurance, which is expensive because it should be closer to like 75. But Florida, the rates are astronomical, right? But that's the thing. So when you decide to go and buy a vehicle, you want to go and buy one that you can count on. You want to buy one that you know is not going to let you down. So if you're deciding that you're going to keep your old school Toyota as a backup and you're going to buy yourself a newer car, I would buy myself a newer economy car, not a newer luxury car, a newer economy car. And if you don't know what that is, just Google a used economy cars under $10,000 in my area. That's it. That's all you got to do. And then every economy car that you can find that is in your area will be listed. And then out of those, you find the one that you like, the way it looks. But an economy car is going to have less damage, less mechanical damage to it because it's cheaper for the dealership to fix it before they put it back on the road. And when you get it, it's going to have less issues that needs to be updated on. But like I said, with every used car, you want to pull the VIN number, pull the Carfax on it, Check and see if it's been in a crash before. You want to see what the maintenance log recommendations are for the vehicle. Then when you do go and talk deal with the dealership, you want to find out if those services have been done on the vehicle recently, if they got the paperwork to show that those services were done. And if they don't have the paperwork to show that those services were done, talk down the price. So if it hasn't had an oil change in the last 6 months, if it hasn't had the brakes done in the last 6 months, whatever the case may be, and you're like, hey, well, can you come off like $500 or $700 off the price and work that price down so that after taxes, if you're getting the car for $9,000 after taxes, that's way better than getting the car with $9,000 plus taxes, which might cost you an extra 900 bucks. So if you can shave $900 off the price of the car, do that then. If you can shave $1,000 off the price of a used car, where tax, title, and license, you're paying that $9,000 out the door instead of paying the $9,000 plus an extra $1,000 in taxes and title and fees and stuff, where you end up paying $10,000 for the vehicle instead of $9,000 for the vehicle. That is a whole nother ballgame. And ultimately, Stephen, you want to put yourself in a position where you're not financing a second time, because once you pay off the one car that you got, you don't want to have $250 a month payments on another car that you're buying. You get it cash up front or you don't get it, right? If you got to trade in your old car, your old Toyota, as a down payment, and then you pay the difference when you drive off the lot, you drive off the lot only owing nothing to the dealership. That is going to be the smartest financial move that you're going to make. And you're going to be able to do that more effectively with an economy car. It's not about what the bitches think, because again, if you're on a college campus as a middle-aged man talking to the bitches on a college campus that are going to be between 18 and 25, they should respect your sage advice as an older man that is talking about being fucking successful, as opposed to he's handsome and he's got an expensive car or an expensive looking car, right? That's going to be the dynamic that you want to deviate away from. Because if you're only getting the chick because of the stuff that you've got, you now have to keep up with the Joneses to keep her attention. Now, when you think, well, I'm not trying to keep these girls, I'm just trying to hit it and quit it, one night stands, blah, 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 blah. Bro, you don't need a car for that. All you got to do is just pay for the Uber. He said, I just put about $5,000 into this car. It will never leave my side until it does not run. And that's my point. So why are you looking at a $9,000 Benz when you just put $5,000 into your Toyota? Like, that's my point. That's my whole point. My whole point. Because if you were getting rid of your Toyota and you were going to sell your Toyota and then put $5,000 towards another car, it would probably be a newer model Toyota. You might get rid of your 80s, 90s model Toyota and get you like a 2010 or 2015 model Toyota, and that for $9,000 and $5,000 of it was cash plus a trade in. That would make sense. But to park a Toyota and get a Benz, that's a waste of money. To trade a Toyota for a Benz, that's a waste of money. You might have could have found a Lexus for $5,000, but no, that's a waste of money. And you got to think, because I had a 2003 Chrysler 300 that was with 83,000 miles, that was like $8,000. So when I found the 2008 Cadillac with 155,000 miles for $4,000, to me that was a steal, because it was cash up front. I had $6,000 in my pocket, and I was like, no, I don't want to spend all of it. You know what I mean? So they got it to me for $4,000 out the door. Tax, title, and license, $4,000 out the door. So I still had $2,000 left over. That's why I bought the Cadillac. I didn't buy the Cadillac because I wanted a luxury car. I bought the Cadillac because it was fucking practical. It made sense. It had the same gas mileage that the Chrysler had. It has the power seats, the power windows, it has the fog lights, it has the sunroof, it has all of the amenities that I would want to have in a car. Didn't have air conditioning, but it had everything else, So for $4,000, that was a good deal for me. But I didn't get it to impress people. But people are impressed when I pull up with it, because they're like, shit, that motherfucker's still running. Not, wow, that's a good car. It's like, wow, that motherfucker's still running. you know, and I drive that car cross country. I drive that car cross country. I can't say that I'm gonna drive a Benz cross country, but I definitely drove that Cadillac cross country. Right? I got a 2020 uh, Dodge Ram 1500. That one was like $45,000. I think the Cadillac was a better buy than a Dodge Ram. Because technically I could have bought four Cadillacs. Well, actually, I could have bought 10 Cadillacs for the price of that Dodge Ram. So I think the Cadillac probably was a better choice. So going forward in the future, when I start looking at other cars, if I think, well, one of these cars might be too old to fix, that's never true. But when they stop making the parts for it, you stop finding mechanics that are capable of fixing it, and you end up in a position where the car is broken and it cannot be fixed. That's when it's too. That's when I want to trade it in and get something else. And when I trade it in to get something else, I'm looking at a cash buy. I'm not looking at and then I'm only looking at how it benefits me. I could give two shits about the people around me, right? Because that is going to be what we had talked about last week, which is um, flashing your wealth. You're doing it for social acceptance. You're. It's loud wealth. It's not the silent wealth that I promote that I tell you guys to should aim for. You don't want to get a Benz and look rich, look like you got money, so that the girl will expect you to pay for the date. You want to look like you're normal, or fuck it, look broke, so that she's not expecting you to have money. So if you offer to pay, it's a fucking generosity, which is what it was supposed to be to begin with, and she's actually appreciative instead of sitting there with the expectation and the handout like, oh, you should be paying. You drive up ends. No. And Lord knows, I don't want to park an expensive car in front of a non-expensive house. You know what I'm talking about, Steve. I don't want to do that because when you start trying to impress society, if your car costs more than your house, nobody is going to be impressed by that. They're going to think that that's a waste of money. You're not going to get the social applause that you think. Yeah, people are going to know that you waste money, and then the women are going to come and talk to you because they think that you're going to waste money on them. And yes, if you've got a little extra money from your student loans and your scholarships and stuff, and you decide to throw a couple $100 down on taking a couple of sorority girls out on a night on the town, that you might actually get laid with some hot sorority girls that are half your age. But it's a waste of money. On a college campus, what I would be looking for at my current mentality is the type of women that are ambitious to the magnitude of growth and cooperation with me, even if we're not in a relationship. My female friends on my campus, which are basically going to be women I wouldn't be willing to sleep with because no guy makes friends with chicks that they're not willing to sleep with. My female friends would be women that I can make money with. And those are going to be the only women I'm going to have in my on my scenario. So if you see me with 10 women and you, oh, he's a pimp. No, I'm a prophet because there's 10 ideas behind me, and we're about to put them all to work so that everybody can make money for us. That is the mentality. If you got girls that are ditzy, they don't know what they want to do. They're just on campus because their mother's paying for their tuition or whatever the case may be. They haven't quite figured shit out. That's not beneficial to you. Oh yeah, they're cute. Yeah, they might dance nasty in front of you and everything to that effect. But at the end of the day, Steven, you don't benefit from none of that. It cost you to get there. You had to pay to get to the event. You had to pay for their attention. You got to pay at the bar. You got to pay for parking. You got to pay, so that you can look at something that's not going to turn you a profit. Again, that brings us back to what we talked about 45 minutes ago is that you have to ask yourself before you spend this money, is what I'm spending my money on an asset or a liability? So let's say you meet a girl at the college. She's got a dad that's a used car dealer. You've got a car, but you could get a second. You and her out at dinner, y'all are talking. She mentions this, and you might help her study. And in return, she introduces you to her father, and he gives you a discount on a car. That girl is an asset because she knows somebody who can put you in a car cheaper than the $9,000 car you're about to waste your money on. Alternatively, you're looking at a girl across the room. She's hot. You want to get to know her? What? You got to pay for cover. You got to pay for gas. You got to pay for parking. You got to pay the tab. And the only thing that you're probably going to get out of this is laid. That's a liability. That's a liability. For the fact that we talk about on this show just about every week, how women believe that their career, that their education, and their alleged skill set are things that make them valuable. As men, I call bullshit. And I believe that we should put that shit to the test. That if they really believe that their career and their knowledge and their skill set is what makes them valuable, then show me your value. Don't just come up here and think that because you're cute that you're supposed to get on my bar tab. I need to see the value in you before you get on my bar tab. I need to see the value in you before you get in my car. So as men, we need to stop parading around our resources, peacocking to attract women. Because our resources is what they want. So at the end of the day, you don't even know how much I have. I need to know how much you're worth to me before I show you what you will get from me. And it should not be the other way around. My assets should not be on display like a kiosk at a job fair for all the chicks to pass by until one of them decides to sign up. Elon Musk is a billionaire. And without knowing his name, he is a billionaire. When you look at him, he dresses normal. Jeans, t-shirt, sometimes with a print on it, sometimes a blazer, regular ass shoes. He's a fucking billionaire. He might not buy his shit from Walmart, but the fact is that his clothes does not look like branding all over the place. He drives the car that he created because he created it. But what other vehicles are you seeing him in when he's not in a Tesla? They're not luxury cars. They're regular cars. At the end of the day, he reinvests in himself. And if that's the billionaire mindset, why are we not doing the same thing? So the people that he's going to give his time to are people that he's going to benefit from. A press conference talks about things that investors want to know. So I'm sitting with you for free because the people who are listening to this are going to give me money. That is the return on your investment. But if you're talking to a chick to get laid, that's no return on investment. That is a bad decision making skill. That, in the sense of our bridge loan conversation, would be a bad business deal because you're putting up all of this extra money with no return on investment expected. And we should never be putting ourselves in that situation. We should never be setting ourselves up for the downfall of if I buy X, Y, and Z today, then I might get bitches next week. No, no. I should be curating the group that I socialize with to make sure that they put money in my pocket the way they will get money in their pocket by being around me. Not because I'm going to give it to them, but because I'm going to show them where the money's at. I'm going to show them how to get it. I might even get it with them, but you're not profiting off of me. You're profiting with me. And that's what men have to change their mentality of. Any reasonably valuable woman that's going to be a female friend or whatever, she's only there because you're profiting together. She's not profiting off of you. You're profiting together. If you're not profiting with her in your presence, she is a liability, and you need to remove all negative liabilities out of your life. Otherwise, that is the quickest way to stay broke. because you start paying for these females, and they'll say, yeah, they'll accept the gifts, they'll accept the anklets and the bracelets, and they'll accept the bar tabs and the free rides and the free food and the lavish gifts, and they'll accept because you're offering. Some might even demand it, but at the end of the day, once you lock that female in, you're a paymaster for the rest of your life. You're gonna forever pay to keep her there. But if you find a valuable one, the only time that she's talking to you is when she's trying to put more money into your pocket. The only time you're talking to her is to update her on how y'all are being successful together. That is the kind of relationship that you need to be in these days. And until you find that, you need to be focusing on your grind. So don't go get that Benz. Don't go get that Benz. Don't. If I was you, you just put 5 grand on your Toyota. If I could find another 5 grand to put on this Toyota so that none of the check engine lights are on, do the tune up and everything on that bad boy. Maybe if you got to repaint that bitch, the original paint job, just repaint, update the paint job. That's it. That's all I'm doing. That's it. If you want to update all the cosmetics on it to make sure that everything's functioning in the vehicle, the restoration project. I would do a restoration project on a car that I own before I spend a bunch of money on a car that I've never had before. And I've driven a lot of cars in my day. They drive differently, but they're all the same. Not mine and not my responsibility. And you want to keep it that way. Now, you want to make sure when you're dealing with these lenders, you want to do your due diligence on the lenders. You want to look for a company with a long track record of positive reviews where they're not fucking over their borrowers. A legitimate lender will be transparent about their rates and their fees. You want to be wary of anyone promising terms that sound too good to be true. You want to read the contract and read the fine print because an experienced bridge loan broker can be one of the most valuable guys in this particular process. Now, when you get a term sheet, you want to read every single line. You want to pay special attention to the default rates, extension options, and prepayment penalties. And prepayment penalties means that if you pay it off too soon, that there's actually going to be penalties involved. You need to understand the cost of every possible scenario. Now, the single most important question that you can ask a potential lender is this. My plan is to exit in 12 months. What happens if I'm delayed by three months or 6 months? What about that? Show me in the contract exactly what my options are. And I can tell you that a reputable lender will have a clear, predefined extension process. Though it will be expensive, it will be clearly defined and understood. A predatory lender will be vague or very dismissive. If they can't give you a straight answer, just like the car dealerships, when you ask them for the itemized price of the car, why are you paying so much for the car? Oh, don't worry about it. Let's just focus on your monthly payments. Tell me what your monthly payments is. I'll talk to my boss and I'll see if I can work it out. That deception, no, bro. I want to know what I'm paying for. What's the initial price? What's the interest rate? What's the final outcome if I pay for the entire life of the loan? What am I paying for amenities wise on this vehicle? Certain things, can you take that off of the price of the car? Like, for example, floor mats, the decals of the dealership. I want all that stuff taken off of the vehicle, or come down on the price. Oh, well, it's as is. No, it's not. The MSRP is as is. All of the extra amenities in the price that is not part of the car. It's not bolted into the car. Can come out of the car, and that would actually remove the price. Because why am I paying $150 for floor mats when I can pay $20 at AutoZone for fucking floor mats? So the same floor mats sometimes, just without the dealership logo on it. Right now, above all else, you must have a bulletproof exit plan. You must know how you're getting out of the deal before you even get yourself into the deal. And you must have a backup plan in case the original plan doesn't go the way you want to go. And for the highly experienced individuals, you want to have a backup plan for the backup plan. If you thought you were going to fix a flip, turn it into a rental property. You thought that you were going to be able to refi and you might have to wholesale. But you got to make sure that you do this in the right way so that you have a way out of this deal so that they're not taking all of your assets and all your efforts. If your exit is a sale, what's your plan B? If the first buyer falls through, what's the absolute lowest price that you can accept? If your exit is refinance, have you already spoken to a mortgage broker who has reviewed your situation and confirmed that you have a realistic path to getting approved for a long-term loan? Remember, I told you guys, test your ability to get loans before you start trying to put yourself into a situation with high loans. And you must stress test your own assumptions. Assume your project will take 50% longer and cost 20% more than you plan. Does that type of deal still work for you? If a thin profit margin turns into a loss under a stress test, the deal is too risky for this type of finance. You're asking an outlandish question because you're asking what's the rates and never take out equity. Um, I don't even think that you understand your own question with that, because rates are going to be the interest rates, the cost of borrowing the money. And then you're saying never take out equity. Well, unfortunately, my guy, that's a double negative, because actually the equity in the property is going to be leveraged towards the loan. And that's what taking out equity means, is borrowing against the value of the property. So how are you not taking out equity on the property that you're leveraging for the loan to accept the rates that are being offered? You're not making any sense. Now, never take out equity on the homestead that you live in to do a high risk business deal with fixing and flipping properties. I can agree with that. Uh, but I mean, otherwise, you're not making any sense. He says rates went down. I refused at 3% and saved. What? What are you talking about? Rate? Okay, so first of all, rates are still high with real estate. Rates have not gone down. Last I checked, they're still between 6 and 8%. For the most part, around 7%, 6.5, 6.9%. You're refusing at 3%. I don't know anybody who's offering 3% of anything in real estate. So I'm not sure. I don't really know any loans that are offering 3%. You might be talking about a CD at a bank that might be 3.1%, but I don't know any legitimate deal that has 3% interest rate involved with it. Even a lot of the brokerage assets that we have are 5, 7%, 4%. I don't know anything that is 3%. You said a 7.5 V to 3 locked. Well, congratulations. That sounds like a too good to be true deal. I would have to see the paperwork to verify it. But that's to me, that's not a real deal. If your cousin offer you 3% on the deal, that might make a little bit of sense. But no, I haven't seen anything like that. Typically, when you see like 3% of like $5 million or some shit like that, 3% of like 100 acres of property, and the reason why the percentage is so low is because there's millions of dollars involved. Because 3% of like $10 million might be like $300,000, versus 3% of the average property between 500,000 or less. 3% would be closer to like $15,000, and nobody's doing hard money lending at 3%. Okay, when regular 30-year fixed mortgages are doing like 6 and 8%. You're a VA loan and a refinance, a stress loan that does the 40-year 2.5%, and that's the only one that does it is the VA. All the rest of them are doing the standard market rate, which is like 7. So that it's not. I don't know. I have not verified what you're talking about. So I mean, if you got it, congratulations. But I've never seen that in the last 2 years. 3% for real estate. Now, the world of bad credit bridge loans is a place of incredible opportunity and devastating risks. So there are financial chainsaws that you guys got to pay attention to. In the right hands, you can clear a path to wealth or seize a once in a lifetime opportunity. They're going to speed things up when the bank would offer a sloth position and access when the system has shut you out. But the trade off is going to be severe here. This speed comes at a brutal cost, both in interest rates and in the unforgiving nature of the terms. Um, you're stepping into speed versus cost traps, where the allure of fast money can blind you to the crushing weight of its price. The short term and the massive balloon payment create a ticking clock that waits for nobody. Steven says, I think I won't get my first house in the next 3 years. It is great to learn all this stuff now. I would totally like to get into fixing and flipping. I, if your dad owns his own place and you're going to inherit that place, I agree. I would go ahead and ride the wave of inheriting whatever dad's got, and then start by doing some fixing and flipping with some real estate. I personally don't think that it's a good idea, even in this market, to do fix and flips because you need a lot of money up front to get it started, even if you use somebody else's money, and then you have to rely on somebody else taking that debt off your hands. I would recommend that you would do fix and rents. You know, I think that would be more beneficial. And the reason why is because each property that you have, even if it's tied to a mortgage, each property that you have would be generating an income. And that income would be income you don't have to work for. The more properties that you have paying you rent, the more liquidatable capital that you have. If you ended up in a position, you say you're trying to wait 3 years from now. If you were in a position where you had like 3 to 5 houses and you decided to refinance and pool all of those houses together in a larger loan, um, you could find yourself potentially going from 3 or 4 small single family homes to one apartment complex and massively maximize your profits. Um, the difference, because real estate is going to be one of the ways that you're gonna make big money over time. So even if you were to buy an apartment complex, a quadruplex, a duplex, a fourplex, whatever, and at least one of those units is yours to live in, and then the rest of the properties are being rented out, you can still find yourself in a place where you don't have to own a single family home if you can live in one of the units of the apartment complex for free. Especially if the apartment complex will pay for the standard utilities. You don't have to pay any rent, light, gas, or water. You don't have to pay for any maintenance costs. You don't have to pay for landscaping or anything. Your tenants is paying for all of this stuff. All you got to do is pay for your phone bill and your car note. That is a better lifestyle to have, and then you can start using your money in other places. He says he owns a broke down trailer with no land. He pays for lot rent. That trailer is trash. That don't mean nothing. The thing about it is, Stephen, is that when you're ready to go from living in a secured location, because that's what you have, whether you value it or not, the lot rent is guaranteed. The landlord is not a dick. You're not looking at forced relocation. It is a guaranteed spot to start for you. That's what you need to pay attention to. Start building cash flow first and then start going into expansions. If you go from single family homes that are being rented out where now your tenant is paying your lot rent, your rundown trailer is being paid for free. Eventually you can go from single family homes into duplexes, fourplexes, quadruplexes. Then you can move out of that trailer into an apartment complex that you control. Then you can move from that into one of the single family homes that you control. And ultimately, because your tenants, the other tenants that you have, are paying for the house, the fourth or fifth or eighth house that you get, that might become your homestead. And all of the other tenants are covering your costs. That makes more sense, right? But if you say, well, I'm going to walk away from this dirt cheap lot rent because I don't like the quality of this trailer, and I'm going to generate a unnecessary monthly income to rent an apartment or own a house or rent a house just so that when people come over, I look more prestigious. You're still making a financially responsible decision because nobody needs to come to your house. Nobody needs to come to your trailer, especially if you had a Bentley outside. Why would you put a Bentley outside or a Benz outside of a trailer? You don't want people to come over to the house because you don't want people to know what you have. It's not about because I'm embarrassed about the trailer. It's because I don't want anybody to know what I have. I'm in the middle of fucking nowhere because I don't want anybody to know where I am and what I've got. And the idea about that is that if nobody knows what I have, nobody has the initiative to try to take from me what I have. This prevents me from spending unnecessary money. This prevents me from spending unnecessary money in litigation. This prevents me from spending unnecessary money on people who think that because we're just friends, that I'm supposed to be able to fund their entertainment. Your best bet is to stay where you are and expand the cheapest way possible, have the cheap overhead, the cheapest personal overhead possible to take all of your extra capital and reinvest that into making money make money for you. And then as your expenses or as your profits and income increases, then you can decide to upgrade your standard of living. Only at the point where the income that's coming in as a profit is three times or five times the value of what you're trying to get. So when you start getting, $5,000 a month checks from your rental property, then you might want to get a $1,500 a month apartment. But until you're getting $5,000 a month checks in rental properties, you need to stay where you are with the trailer park. Ivan says, I agree with that guy. Go for cash flow first and refinance later. This guy says, well, in 2020, 30-year rate locked in was at 2.6 for COVID in January alone. There were dips in decades, just good timing. Those are Minnesota rates. Okay, so those are rates that you got a fixed mortgage from 6 years ago that you're referring to right now, which doesn't exist in modern real estate. So congratulations. Like I said before, that's not an existing rate. Um, and interest rates used to be lower before the real estate boom. Interest rates may go down over the next 5 or 10 years, uh, but that really depends on how the real estate market is going to pivot with the new real estate laws that just came out over the past 3 weeks. And it's going to take another year to 2 years to see how the real estate market changes because with all of the forced sales that is going to happen from the new laws that just came out with real estate, you're going to have more of a buyer's market where sellers are going to be forced to sell single family homes and more people are going to be able to get it cheaper than uh, uh, what they were getting them before. But you also have to understand that as long as we're at war, interest rates are not going to go down. And as long as interest rates don't go down, you're probably not going to see like 5% or 4.5% unless you're like a veteran with good credit. Yeah, not today, but dips will come again. Oh yeah, they typically every 5 or 10 years the dips happen because the 2008 crash, the 2019, which was like 10 years later, 10, 11 years later. So 2028, 2029, we should see another dip. But we're not there yet. We're like 3 or 4 years away from that. In 3 or 4 years, if everything goes the way it's supposed to go, then we likely will start seeing like 3 and 4% interest rates. And anybody that's got a property right now that's under a 6 or 7% uh, 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 mortgage situation, when it does dip to 3%, you might want to refinance. Refinancing is smart and not smart at the same time because if you refinance a 30-year mortgage and you're 10 or 15 years into that mortgage, you're extending your mortgage for 30 years. But if you refinance the 30-year mortgage and you're still paying the original premiums, You have a lower interest rate, which means that you're putting more money on the principal, which also means that you can pay your loan off faster. That's not something people think about. People will refinance and then pay the lower premium to save money today while spending more money over time. But if you refinance and reduce the interest rates, if you were paying $1,500 a month right now with your current mortgage and you refinance and now you're getting like 3%, which is half, and you're still paying that $1,500 a month, you're putting more money on the principal, which means that you can pay the house off. And when you refinance, you're going to be refinancing off of what you owe left over. So while you might have originally financed the house on like 80% of the value of the house or 100% of the value of the house, when you refinance, you're probably going to be refinancing at 50% of the value of the house, which means that at that refinance, you're going to be significantly lower, where your $1,500 a month payment might actually now be closer to like $500 or $700. But if you're still paying that $1,500, you could pay the house off in 10 years, which would kill the mortgage. That's why I did it. Never took any equity out. Well, if you got 3%, well, okay, so if you got a 3%er, you don't really want to refinance and take any equity out of the property. You want to pay that property off. Um, and but again, if you got a 3%er, depending on how much the house costs, at the end of the day, if you did need some money to expand or invest in real estate with 3% on your initial investment, you should have a substantial quantity of equity after 6 years of paying on it if you were overpaying on the house. But if you were paying the bare minimum, you got it at a dirt cheap rate. You've been paying it for 6 years. You might have only put like 10 or 15% towards the total value of the property, which could accumulate for like 20 or $30,000 of equity into the property, depending on how much you put down. If you put down a decent amount in the beginning, you might have 50 or $60,000 of available capital right now towards the total property, which ultimately you could borrow against to take 50% of that out and go and get you a second property, turn it into a real estate property, a rental property, which allows for you to have your tenant pay for your mortgage. And then you don't have to worry about paying for your mortgage. You said you was at 7.5 at the purchase date, but then you refinanced and got the 3%. That's a good deal. Congratulations. You caught something at a good position and took advantage of what they were offering at the time. And if I have a living mortgage at the time that interest rates go down, I would do the exact same thing. I would refinance and get the cheaper rates. I would, but when I refinance at the cheaper rates, my next step would be to keep paying the higher premiums to pay off the property. My goal is not pay less money on the property. My goal is to have less money going towards interest when I refinance so that I can pay the property off sooner. Yeah, good sum of money on the down. Yeah. So you guys got to remember that bridge loans are not going to be a solution for everybody. It's merely a vehicle. Your exit strategy is going to be the solution for your real estate observations. And your entire focus from start to finish must be on how you're going to pay back the lump sum cash on time. So if you don't have a clear, realistic, and verifiable answer to that question, you're not making an investment. You are making a bet that you can't afford to lose. And ultimately, when we start talking about because in the past, like you said, 6 years ago, 10, 15, 20 years ago, things were financially better in the economy. And the stuff that we used to be able to do and get away with back in the day, we can't pull that shit off in 2026, going into 2027. We have to find another way. And that's why we cover these different topics on a regular basis so that you guys have other alternatives to finding another way. But before you take action on finding another way, I gave you new questions to ask. Now you need to do your research and you need to be able to verify which ways work best for you. If you've got a 3% property, you don't want to refinance that 3%. You don't want to take a HELOC out on that 3% where the HELOC is going to be at 7% because that's going to give you an average higher interest rate. But if you're taking out a HELOC on a property where you might have 100 grand available on like a $500,000, $700,000 property, and you might want to take 50% of that out and go and get you a second property so that you can get you extra income. That might be a good idea. If you HELOC your original property to get you a second property that's going to pay for both properties, that's an investment. Yeah, that 7% fucking sucks, but it's the cost of doing business when somebody else is paying that 7%, right? That's the difference. If your total mortgage is covered by somebody else, if you even if you were to leverage the whole current house for a second house, which I don't recommend you doing that with your homestead, but if you did, where both houses are under one mortgage, and now you're paying for two houses for $3,000 a month, and the other guy is paying $2,500 of it. You now only got to pay $500 towards the mortgage. You can keep paying the $1,500 a month that you was paying, but you'll find yourself being able to knock that mortgage down quicker. You'll be able to cover a lot of that extra profit under a tax blanket of paying back a loan, which allows for you to defer from having to be responsible for a lot of taxation on your properties. You could pay the properties down quicker, which allows for you to be able to do some shit like refinance that shit a third time. Because if I took out a HELOC, I would have invested in gold, but can't see it in the future. Uh, I would not invest it in gold. And the reason why I wouldn't invest it in gold is because if I took out a HELOC, the interest rates year over year is not nearly as much as the cost of the HELOC. If I was to take out a HELOC, I would put that into a high interest real estate investment trust that's paying 22% return on investment so that the 7% on the HELOC is going to be less than the 20% return on investment on the brokerage account. I can use the brokerage account to pay off the HELOC, keep the principal, and use the principal to generate more dividends so that I can use that money for something else, which again could free up the capital in my house where I don't have to pay for my house anymore. If I could borrow 80% of the value of my house and put it into a brokerage account where I'm getting 20% return on investment, and I take that 20% return on investment and put it on the house where the house gets paid off. Now I don't owe anything on the house. I still got the principal in the brokerage account. I didn't have to pay for the house. The brokerage account paid for the house. I actually benefited from that HELOC as opposed to gold. Gold wasn't 300. Was gold $300 an ounce in 2006 or 2019? I'd have to talk to Michael about that. Michael knows because gold was like $200 an ounce back in the 70s. And if you would have took out a HELOC back in the 80s or 90s and you held it until 2026, where you can now at $300 an ounce sell that at like 10 times more than its current value or its original value, then yeah, if you would have bought the gold. But then again, when you still think about how the year over year growth from $200 in 1976 to $4,500 in 2026, what was that? 50 years? 50 years to gain what? $3,400 an ounce? 50 years. Now, again, if I'm putting it into a high interest brokerage account that's giving 20% return on investment year over year, 5 years I would double my money. I mean, yeah. When you think about on paper how gold used to be a certain quantity of money, if you would have bought all that gold back then and you still would have had it, you could sell it now because it's only a profit once you sold it. Then yeah, you probably would have had something. But think about opportunity cost. If you're getting 20% return on investment, in 5 years you double your money. 50 years, you would have doubled your money 10 times. If you would have bought, let's say, $50,000 worth of gold, now it might be closer to $500,000 worth of gold. But if you would have bought $50,000 worth of gold and you would have been getting $10,000 a year plus compounded interest, you would have had $50,000. You would have had like an extra $60,000 or $70,000 in the first 5 years. If you just had the principal, didn't add anything else on it, just let the compound interest drip on it. you would have inside of 10 years, maybe 20 years, you probably would have had a $500,000. By the time you got to that same 50-year mark, you probably would have like 1.5, $1.75 million. Opportunity cost. Gold is stable increase, but the opportunity cost, the higher volatility in the real estate investment trust that has been around for the last 50 years would have been way more profitable to you, which means that you ultimately would have been making a shit ton more. And then real estate investment trust pays you dividends every year. So, or every month, matter of fact. So instead of just having $500,000 of gold on paper, $1.75 million that's paying you 20% return on investment, where you would likely be getting $300,000 a year, probably would have been way better. He says, I hear silver might be going up, but not sure. Silver's going up right now because we're at war. Um, but silver's going to go back down again when we stop going to war. So what's happening right now is directly impacting the price of silver. Uh, Silver used to be 10% of the price of gold, but now it's not. Silver is right now right around $65 per troy ounce, where gold is right around $4,500 per troy ounce. Copper is right now $6.80. I would say per pound, but I calculate closer to the same, which is 10% of the value of silver. So um, you might see, while we're still in conflict with Iran, you might see silver go back up an extra $10 or $15 per ounce. But once they settle that squabble, whenever that does happen, it'll go back down again and level off at around $60 or $65 an ounce. So if you're trying to ride the wave of volatility on silver and make that $10 or $15 an ounce quick money and buy into it now, and then when it spikes to like $80 an ounce, you sell it and just sell it. Don't try to ride the wave to $85 an ounce. You want to sell it because the day that Trump says the war is over, the next day the stock will plummet. So you want to, once you hit like $80, you want to just sell it and then benefit from the fact that you had it. Then when it goes back down to like $65 an ounce, buy back in and be able to benefit from that particular situation. But it is not going to revalue itself to the $4,000 that gold is. If it doesn't revalue itself to 10% of what gold is, where it goes back down to like $50 an ounce, gold might spike up to 5,500 by mid 2026. I mean mid 2027, but it's not worth doing. Yeah, right. Too old to ride the waves. I'm retired with a good pension, Social Security. But that's my point. That's my point. That's what I'm saying. I would not be doing gold and silver when I'm trying to ride on a pension. If I'm trying to ride on retirement, I'm trying to live off of the dividends on my investments. So I'm trying to build me a brokerage account that's a 100% dividend paying brokerage account. I've got some stability and some volatility, averaging out 15 or 18% return on investment. And I'm getting out of every $100,000, I'm getting $18,000. So if I could put away $200,000, $300,000, $400,000, $500,000. I've got $60,000, $70,000 a year coming from a brokerage account that I can count on. I can give Uncle Sam $15,000, $20,000 a year and still have $50,000 or $60,000 a year to pay for my standard of living. And I don't have to wonder where my money's coming from. I don't have to give a shit about what's going on with the stock market because these blue chip companies have been around for 50 plus years, paying dividends for 50 plus years, never missed a payment. And, these are the ones that the billionaires became billionaires on. And if we're paying attention and riding the wave on these low cost, high interest paying, especially they're low cost right now because of the volatility, because of Donald Trump's term. All of the decisions that he made set the market into disarray, and that's the reason why the prices are so cheap. So it's not that the market is failing; it's that the market is benefiting you because you can get everything at half price, or shit, 70% off, 80% off, and then just ride the wave. When everything stabilizes, and presidents stop making decisions, and the market starts going up, you can get the growth on the share price, and you can get the dividends that you were locked in at the 20% return on investment. And not too many people are thinking about that. I already got the stock party. I was supposed to tell you about it. The stock party popped up sometime yesterday, and I was like, shoot, I grabbed it. The Netflix one. Yeah. I completely forgot to say something. I just seen it between last night's show and today, and I had grabbed it, and I was like, I'm gonna jump on the show and I'm gonna tell Steven about the stock party. And I forgot. Oh shit! But I'm glad that you kept me in the loop, though. It says I got about 20 grand from interest per year from things I don't need or want. But that's the point. You don't have to give two shits about where the money's coming from. The fact that you're getting 20 grand a year from shit that you don't got to do anything for, that's what retirement is supposed to look like. You see a lot of the wealthiest people in movie stars and a movie industry or whatever talking about how, oh yeah, somebody called me and told me come collect this $75,000 check from such and such movie I did 20 years ago. I didn't even know that movie was still being played because they got back end deals. Bro, it could be garbage that you're getting paid from. The fact is that if they're still sliding you 20 grand per year off of shit that you got yourself involved into 10, 15, 20 years ago, that is a true retirement. Because I don't got to do shit now. I just got to collect the money. Right. And that's what I'm telling Steven to do is to lock it in and start working towards having that money make more money for you. He says, I'm in a mood to grab some Johnson Johnson. No particular reason for the pick, but I will lock it in later today. Bro, you don't see Johnson and Johnson going across the screen? That's one of the picks. Host Hostel Resort, Johnson and Johnson, Oracle Corporation, Broadcom, Sterling Construction Company, First Community, Branshire, U.S. Global Jets. That's some of the picks. You're talking about you talking about some no particular reason. I verified that already. I stake my claim on Johnson and Johnson. It's not part of it's not part of the core satellite that I was doing with the now we've got 22 of them pushed pieced together because I was trying to help you get in with the cheapest stocks with the highest paying dividends so that you can maximize your portfolio faster. But when you start talking about overall like growth in your portfolio, the more stocks that you get that's more diversified in more different places, the safer your overall portfolio is, but the lower your average percentage is across because you can grab 500 companies across the board. Anything over 20 to 25, you've already gone past volatility prevention, and now you're liquidating your percentage return. But if you're going to offset the extra stocks where you start getting 25 or 30 stocks, 40, 50 stocks, and you're still going to have 60% of your portfolio be real estate investment trusts and BDCs, and the other 40% of your portfolio is going to be everything else. You still have 40% of your portfolio that is tax favored, and then the rest of your portfolio is that 20%, 25% return on investment, which you can rebalance into the rest of your portfolio where you could still average 15 or 17% return on investment out the entire portfolio as long as you're not trying to do like 50-50 here and even splits where your 20 something percent return on investment gets liquidated down to 10%. When your average, meaning all of the stocks together, starts averaging the same amount or less in the S&P 500, you have oversaturated your portfolio with stocks. You want to make sure that you're outpacing the S&P 500. And as long as you're outpacing the S&P 500 with the shit ton of stocks that I got going across the screen, because I've had about 25 or 30 of them going across the screen for the majority of the show. And yesterday, this was the second list that was going because we had about 54 stocks that we were following. If you get all 54 of them, you can get all 54 of them. But I would at least grab only the ones that are paying dividends out of the 54 of them, which is probably like 30 or 35 of them. And if you grabbed all of them, plus the two stocks that you found, you probably have like 38. But I would still have 60% 50 or 60% real estate investment trusts and BDCs, and then the rest of them would share the remaining 40 or 50%, where I would still be averaging 15% out of the entire portfolio total return on investment, still being able to benefit from the tax favorable stocks where I wouldn't be paying as much taxes on my portfolio, but I would still have overall a very lucrative portfolio and a very lucrative portfolio where the 40 or 50% of the portfolio that is tax favorable are ones where the share value and the dividend value grows year over year. That's actually more beneficial because my payments will get larger over the next 20 or 30 years. And I will be able to expand those payments by pushing more money into it from my real estate investment trust and BDCs. He says, I mean, the one I got from the membership, I'm picking that one today. I already have some. Yeah, but that's what I'm trying to tell you. That's why I said Johnson and Johnson is in the list. um, it goes across the screen every few days on the show because it's part of the 54. I haven't put that 54 list up there in a while, so I'm gonna throw it back in there so that you can see all of the ones that we're talking about. Matter of fact, I'll put it in today after the show so that you can see the full list of stocks that I've been watching. And these are the ones that I give you the ones that have X dividends coming up. But I have some that are growth stocks like Tesla and stuff like that. But all of the dividend paying ones, we go over those month over month out of this 54 list. So I'll put the whole list back into the membership again so that you can take a look at it and you could see all of the stocks that I'm following. And you'd be like, shit, this dude's been following. He's following a hell of a lot more than the ones he picked. I handpicked the 19 best ones out of the 54 that I'm following. But if you look at the whole 54, you'd be like, holy shit, this is a lot of stuff. He says, out of the two I found so far, only have the Erie out of those two in my portfolio. Bro, I put both of the ones you told me about into the portfolio. What you talking about? Soon as I did a review and I told you about it, soon as I told you those two were worth adding to your portfolio, where you go from having like 17 or 19 to having 20 or 21, I added those two into my portfolio. So both of the two that you found are in my portfolio. I haven't added them to the list and put them up on the screen yet because I just haven't had the time. But in my portfolio, the Erie stock and the CSCW stock that you told me about, I got both of those. I got both of those because they're the dividends grow over the next 20 years. So one of them has an average 10% return on investment, and the other one I think has a 3% return on investment. But the dividends grow over the next 20 or 30 years, and they're tax favorable stocks. So I would add those to my portfolio, and I told you how to add them to your portfolio so that it doesn't negatively impact your overall ability to have 15% return on investment. But like I said, all you got to do really is just put a little bit more on your REITs. He says, I just crossed 3 months on stash and it's a good little start. I would say, man, when you start getting that student loan money, the grants and scholarships and stuff from college, and you start putting that onto your portfolio, when you start seeing 10, 15, $20,000, and you start seeing $1,000 and $2,000 return on investment year over year, you're gonna be like, shit, this is a lot. When you only got like $2,000 or $3,000 into your brokerage account, and you see like $200 or $300, you don't really feel like you did anything. But when you start seeing um $200 and $300 or $2,000 or $3,000 on your $10,000, and when you start seeing like $300 a month, $500 a month, $700 a month on your 15 and $20,000, you start like, shit, this is. But that is the long term results of consistent investing in yourself and your future. And likewise, like I said, if you've got a portfolio where you've got a significant quantity of capital there, 20, 30, 50, $75,000, and you go to some whatever and say, hey, let me borrow X, Y, and Z. They're going to ask you what assets you have. Well, I got this $50,000 portfolio that pays X, Y, and Z per month. Oh, you have a cash generating portfolio. That is capital that can go towards your income because a lot of people get a loan and they only use their paycheck. But it's not just my paycheck. It's the dividends from the brokerage account that adds to my paycheck. So actually, I make more money because I'm getting X number of dollars per month from the portfolio. Which means that when you start talking about what's your annual salary is whatever you make off your job plus whatever you make per year off your brokerage account. Which means that if you're a $55,000 a year guy and you're getting an extra $10,000 off your brokerage account, you're a $65,000 a year guy. So if you needed a $65,000 a year income so that you can get that $30,000 loan, boom, you got it. You just had to mention the brokerage account. And if the monthly payments are going to be the same price or less than the monthly payments from the brokerage account, you're not even paying for it out of your paycheck. You might put 1 or 2 months down so that you can work out how you're going to deposit the money from your brokerage account into your bank account so you can make the payment for next month. But after that, the brokerage account is paying for that bill. That is how the wealthy knocks it out. All right. That's all I got for you guys for tonight. We got a lot more stuff coming up. So we're going to be talking about different countries around the world to invest in. So I want to make sure that you guys pay attention to that. Stephen, I'm going to have your question from yesterday up. I'm going to try to get it scheduled by the end of this week for the next week or two, and I'm going to let you know what day it is. So you're going to see a new one up there, and that's going to cause me to move one that you've already hit the notification button on. But don't worry, I'm going to tell you where that show is at so that you can follow it. I'm going to start off by saying, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. Fellas, like y'all seen all night tonight, I give you this information to make you guys higher value men, not just by improving your financial life, but also by improving your decision-making skills. Ladies, you too, while this is a male-driven podcast from a male perspective, you can make yourselves higher value women as well. I tell everybody to prioritize finding the things that are inside of your life that you can control, finding the things that you don't like about it, and then proactively changing those things, and then navigating around the things that are outside of your control. This gives you guys a better life. Okay. Now, also, ladies, if you figure out your 20 and 30-year plan, y'all can reverse engineer that 20-year plan into what you're going to do today and start proactively following that path. Keep your eyes and ears open for the potential suitor that has the right personality and characteristics, drive, ambition, dedication, motivation, admiration, integrity to achieve his own 20 or 30-year plan, his own goals. When you mesh your goals with his goals and you see if his goals is good enough to go with your goals, and y'all got long-term satisfaction goals, not short-term gratification goals, you can find that the two of you can accomplish each other's goals together. Which is why, Stephen, I was telling you not to go and get the Benz to attract bitches, because their goal is short-term goal is to be seen in an expensive car, be seen with a guy that's going to spend money, and potentially get a bunch of stuff for free. Short-term gratification that contradicts your long-term goals of financial satisfaction, where you are not going to have to worry about where money's coming from in the future. That's why I told you don't do that. Now, ladies, I tell y'all, fellas, I tell y'all on a regular basis, when you find the right partner to roll with, when you find the right squad to roll with, where everybody's working on long-term satisfaction together, you will find that two people can make it to $1 million faster than one. A group of people working together for the same goal can find themselves in a $1 million position faster than if you were doing it by yourself, and way faster than if you were doing it with people that were dragging you down, leeching money off of you, and satisfying your short-term gratifications with your long-term satisfaction money. So with that being said, I want to give a special shout out to Stephen, Michael, Charlie. Special shout out to Charlie. Ivan, I really appreciate you guys for coming to the show. OG Kicks, Aztec, and Unc Andy. So thank you for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow.
Higher ground. Used to chase validation, now I validate That's my personal command. I'm not mounted on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.